in terms of the coursework this week, I want to just kind of let you guys know my opinion, having done this for many years, and having gotten good feedback and some not so good feedback and everything else in between. I'm going to tell you that when you're trying to learn something that's presented in this format, where we have several days, day over day, and an awful lot of information to get through, that it's very easy for you to look at something that's being presented and say, oh, well, that's remedial, or that's too basic, or something like that, and kind of drift off and do something else. Mark is going to be teaching a very full, very comprehensive course, and a lot of the parts of that involve, kind of starting from scratch. In other words, saying, look, for whatever, you may already be a successful trader and you're here to just enhance some stuff, but the majority of the people that come to a class like this are here because they're really trying to put all of the pieces together. And I would encourage you to listen to all of those pieces as they come with an open mind, as though you are a brand new beginner, like it's the very first time that you're hearing it. And if you'll do that and try and take every step along the way, you'll realize that as it circles back, it is a very complete package, as opposed to just trying to get out of it, oh, well, teach me this setup or that setup. That mentality doesn't really work well over time, and you won't get out of this course what we really want you to. 3 things that I can highly recommend for this type of environment. The first one is to focus. I know that's easy to say, but it's very difficult to do. Okay, what I mean by that is turn off your email, turn off the ringer on your phone, and give this the attention that it deserves. You've paid money for it. I would highly recommend that you actually focus on the content. Even if it seems to be remedial, make sure that you're focused. Number 2, the second thing that you can do to get an awful lot out of this is actually participate. There's a lot of scientific evidence to the fact that passive participation, just sitting there and listening to something, or sitting there and glossing over something, basically has no benefit to you at all. Okay, so the more that you participate, ask questions, even if it's just taking notes about things that Mark's saying, and circling back to it, because a lot of things will obviously be answered. But I can't stress it enough. The more that you participate, the more you're going to get out of this. And so try, even if there's a language barrier or anything, there are no stupid questions. There's no need to feel as though you can't be part of this class, just as if it were in a lecture hall. So please try and participate. And the other thing that is what I would say the third thing that's very important for this type of kind of educational blast is to plan on pacing yourself. Generally speaking, nobody can sit down and absorb the actual information that's presented in a 3 or a 4 or a 5 hour, and particularly over a multi-day environment. What I would suggest that you do is have a notepad in front of you and pace yourself in terms of just keeping a few notes about things that you need to either revisit, you're not totally clear on, you want to make sure that you go back into the recording, and that way, essentially what you're doing is you're kind of giving yourself a mental break when you hit a wall, right? When something is just kind of getting overwhelming or boring and you want to drift off, instead of drifting off, make a couple of notes about it, maybe the time of the day or something like that. Because it'll take your mind off of it without leaving it completely. So those are the 3 things that I highly recommend everybody try to take advantage of, so that this course really delivers everything that we want it to. So with that, I'll cut over and let Mark take the show. This is really his show. I'm here to moderate. I'm here to learn, and I'm here to help anybody along the way, and I'll be participating in the course as well at times when I feel like nobody else is asking the question. So I certainly can. That's not a problem at all. Sorry, I didn't have any idea what you were talking about. Anyway, so without further ado, I'm going to turn it over to Mark. This really is his course. He's what I believe put together something very comprehensive for OFA, not just something about volume profile, but something about essentially all of the pieces that we offer and how to put them together the right way. So, Mark, have at it, and let me know if there's anything I can do to help you along the way.
Awesome. Thanks, DB. Just to make sure again, everyone can hear me fine. Just get a quick check. All right, great. Okay, thanks for the intro, DB, and all of the things that he said are correct. We're going to go through a significant amount of information, and we are scheduled to spend at least 2.5 hours a day. That will likely go longer, a couple of days, and I hope that's okay with you all. We're going to get into live charts. One of the things I don't really do is go back in history and show you how specific trades worked or might work. I have found in teaching that most people learn by going through a live chart to understand what's happening, and as either trades or setups or structure is being developed within the market, within the auction, most people can see it developing. They learn better by going through live charts. So this course is not going to be a series of a bunch of screens that I've set up from previous days, and as we go through this and learn, we're going to go through live information, current information, and most of it will be relative to the ES, because simply put, the ES has the most volume, and it's a great place to learn volume profile. In fact, the best place to learn volume profile. So I'm really excited about doing this course with you all. I have been trading with volume profile and order flow for quite a long time, and I truly mean this. This isn't a plug, but when I saw OFA, even just the framework of OFA, and understood what it does and how it was designed, my thought, my comment was, that's the way the auction works, and that's the tool I want to be using. So I'm very happy to be able to be doing this with OFA. So we're going to go through a little bit of orientation just to make sure that you understand how the days are going to go. First of all, every morning I'm going to make sure that you understand what we're going to go through throughout the day. So for each day, you're going to get a sense of what the activities are. And the first thing we're going to do is go through orientation, and talk a little bit about the way the course is laid out. Next thing we're going to do is talk about the actual installation of the indicator. I think that should be pretty easy. And then I want to talk about the market auction, and then go through the importance of order flow. Now, as DB said, there's probably everybody in here understands to some level market auction, order flow, and probably everybody understands it a little bit differently, which is great because it's going to generate different questions. So I'm very excited about the different questions to see where people are. And there's a good chance that everybody's using it maybe a little bit differently. So for example, some people may be using the structure chart. Some people may be using the order flow chart. Some people may be using the cluster analysis. Some maybe not be using the cluster analysis. So everybody probably sees the auction a little different way. And relative to volume profile, in order for you to get the most out of this class and to be able to use what you've learned here, not just for the ES, but into other instruments, it's really important that we all have the same understanding of market auction and order flow in order to move forward into volume profile. So the other thing we're going to do today is we're actually going to create a volume profile, and then we're going to look at the market profile, some elements of the market profile. It is a pretty significant component of the trading and different training. And then we're going to get into other indicators as we're going to go through the course, other levels, other key levels that we're going to want to track relative to the auction. So relative to the orientation, again, a couple things I just want to get out is I've designed this specifically and sequenced this specifically to teach traders how to effectively use volume profile using the OFA tools for trading. And when I talk about being able to use volume profile in different instruments, and we're going to go through that after you have the fundamentals down and kind of see how these pieces fit together. This isn't something, it's not like a Ronco tool or an all-in-one tool, a nice little handy-dandy utility knife. This is a understanding framework, understanding a market's architecture and structure so that you can effectively utilize the order flow print, the volume cluster analysis, momentum, the structure charts, all of the tools within OFA to be able to move to any other instrument that collects volume and effectively trade it, or at the very least be able to understand what is happening in the market between buyers and sellers. But it's important that we all have the same understanding. There's going to be homework assigned, so tomorrow we're going to have our first test, and then after that we have homework on days 3 and 4, and it's time, at that time it'll be a good time for review and questions. And it's your opportunity to learn. So I can't stress enough how important the homework will be to you learning. I want you to know every question is fair and a legitimate question, even if I've stated it before. If you don't understand something, and even if I've given an explanation, ask to go over it again. I will watch the time and make sure that I get through all of the content. But please feel free to ask your question. In fact, sometimes, many times, if you go back and look at the psychology of learning, people need to hear things sometimes 5 to 7 different ways before it finally sinks in and there's that aha moment. So I want to make sure that we do that. Again, I will monitor the time, so I encourage the questions, and I will also make sure that we have the time to get through all the materials. I want to make sure that I'm respectful of the time that was scheduled so that if people have specifically carved out this time, we can get through it for them. So for risk of missing core materials, I may ask to hold questions for Q&A sessions or towards the end of the day. But please just understand that's to make sure that we get through it all. There'll be a test initially for the fundamentals after tomorrow. It's not a graded test. It's just used to reflect the key elements of the fundamentals and generate questions. As I've taught the fundamentals of auction, volume profile, specifically the auction and the market, I have a lot of traders that say, yeah, we get that, we understand that. And to some degree, everybody does. But what I found with most traders is the fundamentals are not part of their trading. So when they actually get into trading, they kind of leave the fundamentals behind. And so it's important for us to make sure that we start with those fundamentals, which is what today is and tomorrow. Now, don't fret. We're going to get into the charts. We're going to start actually applying this stuff. Even today, we're going to get into a chart and start looking at the chart and the different levels and the auction and the order flow, etc. But every day is meant to build on each other so that when we get to day 4 and day 5 and we're actually in the market and we're looking at opportunities and trades and reading the print and reading the structure, creating trade plans, it all makes sense. So I would tell you that fundamentals are extremely important. Anything that you want to do well in. Take, for example, sporting activities. It doesn't matter what the sport is, whether it's golfing, football, baseball. Those who are stars in their sport, they spend a lot of time in the fundamentals. And it's also important that we all begin with the same base of understanding, which is why we're all going through this part together. And the ability to use volume profile, and that's what I talked about earlier, across different instruments is directly related to how well understand and specifically can apply the fundamentals. So there are going to be things that you might see in a structure chart. There are going to be things that you may see in a volume cluster analysis and or in the print itself that may cause you to make a decision. And without the fundamentals, that decision may put you in a difficult spot in your trade. So I'm going to be using slides for teaching concepts and presenting information, but again, I'll be using charts and live market data for examples and practical teaching. So to some extent, we're going to go through presentations. and because we just need to get through the information. But as we move forward in the course, the template or the screen is going to be a live chart. So in order to take full advantage of the teaching and the time we have, again, I highly recommend you complete the homework and the assignments. That'll be on days 3 and 4. So real quickly, I want to go through the course overview so you get a sense. This is broken down into several objectives, which day 1 and 2, really going through the auction, the order flow, and volume profile, and make sure that by the time we get into day 3 and we start putting together trade plans and looking at trade execution, you understand how all the OFA tools, which represent the auction, and the volume profile work together. So we're going to go through market auction, order flow, some elements of market profile, specifically volume profile, and then tomorrow, after we get through the volume profile, fundamentals, and put these pieces together, there'll be a test for you. And then on day 3, really starting to understand using the volume profile as well as the print, understanding market context and trade planning. Learn how the auction process builds the profile, learn how to read the context in the profile, what are buyers and sellers trying to do across a longer term, mid-term, the different swings that may be across a week or several days, and in the short term, specifically intraday, and even specific swings within an intraday chart. We want to make sure that we identify the auction elements and the process of building a trade plan on day 3, so we can effectively build a trade plan based on the context of the market and what the auction elements are telling us buyers and sellers are trying to do and how effective they are in doing it. So on day 4, we're going to really put the auction and the OFA pieces together. We're going to go through a full homework trading plan process. We're going to build if-then scenarios. We're going to do that for the day. We're going to do that on the fly. So pre-market and developing day. We're going to talk about patience, when to have patience and when to take action. What specifically to look for in the print, what specifically to look for in the volume profile that begins to identify your opportunities for trade. And when I talk about opportunities, I'm specifically speaking to trades of a risk-reward ratio of 1 to 3 or 3 to 1. Now, one of the things somebody had asked me prior to the course is scalping. Can you use this tool for scalping? And I would tell you, absolutely, without question, you can use this method of trading for scalping. You have to define what that means to you. Then we're going to look at how to use the print, specifically order flow for risk management, how to use the profile, how to use combine the profile with the volume cluster analysis and momentum to identify your risk and manage your risk effectively. We know that not every trade is going to work. How do we get ourselves to the point where our risk-reward ratio is always in our favor and we are specifically managing our risk? We're going to talk about trade entry and management, and again, this is specifically using the OFA tools, the print, which is the order flow, the framework, the OFA Ninja framework specifically, and we're going to talk about this today. What about probe and rotation? Do those settings really matter? What about the strong and weak bid-ask setting? Do those things really matter, and when do they matter? So incorporating the order flow and print, and then we're going to talk specifically about trade psychology as it relates to trade entry and management. Now, what I know about traders is they can talk a good game. Most traders can talk a good game and say, oh, here, this is what the market's going to do, or this is where my trade is, and this is what my setup is. And then when it comes time to actually making that trade, the setup will occur, their level will come, and there's a part of them that's looking for all kinds of reasons, either not to get in the trade or for something to show up on the screen that says, okay, go long, you're not going to lose in this trade. And the point is as the moment of truth comes for the trade and you actually enter a trade, the human being, the human mind, goes from a level of objectivity into subjectivity, which means that your ability to read the print objectively significantly decreases once you get into a trade. And so we're going to talk about how all of these pieces can help you in your trade psychology so that you can maintain stops appropriately and let the trade work when appropriate as well, where to take scales on your trade, how to improve your quote-unquote psychology so that you can use this method of trading effectively. So lastly, in day 5, we're not just putting it all together, we are together actually building a trading plan for the ES. And then we're going to do live trading. You're going to see my charts specifically using the OFA tools. And then we're going to go through how to apply the volume profile analysis to other instruments. So we're going to look at thinner instruments like oil, the CL. We'll look at other indexes as well. And we're going to take a look at how to use the volume profile analysis in those instruments and what to look for. And I'm telling you, at that point, all of the stuff that we're going through today and tomorrow in terms of the fundamentals are going to start coming back. And the more that you can recall that and understand those fundamentals, the more ability you are going to have to apply VPA and I would say the OFA tools into other instruments. Understanding that other instruments, every instrument has its own unique flavor to it, and we want to look at the tools, use the tools in the same way relative to the fundamentals and the principles of the tools, but every instrument's going to have a different feel to it and a different nuance that we want to make sure that we are understanding. So for example, thinner volume versus thicker volume, thinner volume on the CL versus very thick volume, high volume on the ES. What do those things mean? And what do they mean relative to things like probe and rotation? What do they mean relative to volume cluster analysis and the strong and weak bid settings? How are those things changed effectively in other instruments to be an effective trader in order to read the auction? And then we're going to look at different market sessions as well and understand why with some instruments trading specific market sessions are important and how to trade specific market sessions. So some people are not just bound to the U.S. time frame and they like to trade maybe the European session. Some people may not be from the U.S. I want to show you how to specifically use a European session with the volume profile to effectively trade the ES and other instruments as well. And then lastly, we'll go through a Q&A session on day 5. Make sure in this day 5, you can probably expect to go longer than 2.5 hours. Probably once we start getting into day 3, 4, and specifically 5, we're probably going to take a good portion of the whole morning on day 5, and we'll see how much further we go from there. And again, I just want to respect people's schedules, but I wanted to let you know ahead of time that we'll probably go much further. So with that, that is the sequence of the next 5 days. And again, I've developed this specific sequence of training and information so that everybody can arrive at the same place at the same time. And specifically, I lean heavily at the front of this on the fundamentals, the principles of the auction, the principles of the market, so that we can build trade plans, we can identify change, we can effectively manage our risk using the market fundamentals, because sometimes what we see in the print and on a chart can fool us. And we want to make sure that the fundamentals are something that are a bedrock to our trading. So with that, I'm going to go through some of this relatively quickly. If you have questions on it, let me know. But what I really want to get to is some of the meat of this today, which is getting actually into the OFA tools, looking at probe and rotation, actually taking a look at the ES today relative to order flow and the auction, the stuff we're going to talk through today, so that I can actually start talking to it and you can start seeing it and experiencing it. So what's important to know is that the market path or the market is understanding and acceptance that it's just a place where buyers and sellers come together to transact business. Now, sure, there are things like high frequency trading, and there are things in specific stocks where there's insider trading, and maybe there's a lot of rigging here and there are dark pools where there are significant buyers waiting at a specific level and specific sellers waiting at a specific level. But if we focus on all of those things that we think serve to take our money, then we can pretty much guarantee ourselves that we will not be effective. And even if there's high frequency trading and dark pools and those other things out there, they still leave a trail. They still show what their interests are. They show what where they're getting aggressive, where their conviction levels are, where they are weak, where they have belief, where fair prices are and unfair prices are. And as we look at that in the most current context and then start moving out and out, we can start to put together a picture of what we know about them, regardless of where they are or who they are or what their intent is. So I want to make sure that we get through some of that right now. Buyers and sellers are the market. And when I talk about buyers and sellers, I mean active buyers and sellers. The one thing that you will never, ever be able to do as a trader, and you can just lay this aside right now, is identify or understand who is sitting on the sideline that's ready to step in and push price one direction or another. But the buyers and sellers of current activity that are engaging in pushing price up and down, they are the market. It doesn't matter what somebody on CNBC says or in an article or a newsletter. In fact, it doesn't even matter what I say. The only thing that is going to move price and determine where price is going to go are the buyers and the sellers. And let's face it, I personally don't know of any retail traders who have the ability to move the market, especially in the ES. And again, only active buyers, sellers can move price. Why is this important? It's important because so many people start focusing on the things like the dark pools and what might this do, what might that do, that they miss the opportunity because the print and the auction is telling them something very clearly. And if you understand how to manage your risk well, you can keep yourself from any significant harm by understanding where to trade and where you need to get out. But when people focus not just on the active buyers and the sellers on what could happen, they start to create a certain psychology that prevents them from being objective. So only active buyers and sellers can move price. What that means is what we see in the print, what we see in order flow becomes incredibly important. It is what we know. It is all that we know. Outside of what we see in the print is uncertain and ambiguous, and the market will always be uncertain and ambiguous. And as long as you can deal with that and understand that, and I have a lot of people that say, yeah, I get that. We know. But they don't know relative to making their trades and specifically managing their stops. So it's very important for us to understand what we see in the print is all that we can know. What we read in the volume profile is all that we can know. We make our trades based on what we know. If we're wrong, we have more information and we move on. If we're right, then the market confirms what we're reading in the structure and what we're reading in the print, and we keep moving forward in that assessment. Now understand also that price movement is what makes our trades win or lose, and that's so obvious, but it becomes fundamental as we get the print. Therefore, we only want buyers and sellers to influence our trading decisions. Nothing else matters. Okay, when news hits, we don't know if price is going to go up or down, but it is going to go up, it is going to go down. But we want to look at the print, we want to understand where the conviction levels are, where the weakness levels are, and we want to use what they are telling us to influence our trading decision. Again, nothing else matters. In fact, you can talk to a lot of people who have been stopped out significantly over the last year and a half, 2013 and 2014, because their sell buttons have been nothing more than a contribution to the buyers. I mean, you can logically think about our markets and look at the steep incline and say, well, it's got to pull back, it's got to pull back, because you think that this market has to pull back at some point. But the print and the auction kept telling us all along that buyers kept building platforms, and the market kept accepting prices higher and higher. There was never any, outside of wars and news, there was never anything that suggested in the normal auction that we had responsive selling and sellers were beginning to take a stand. So again, what you think should happen in a market and an auction is going to significantly impede your ability to trade effectively. So all of this is to say we have to look at the print, we have to understand the structure of the market using our structure chart, our prints, the order flow, volume profile, to understand what buyers and sellers are telling us. Nothing else matters. It is the only truth that we have in the market. And it is the one thing that should influence our trading decisions, not what we think should happen. So as we look at this, and just had it open on the ES, every market, it's a function of the auction that facilitates price movement. And when you understand the auction process and the guiding principles, the fundamentals, they are the foundation to effectively listen to the market, meaning listen to only buyers and sellers. This is the thing that is going to keep you from taking your stops and throwing them outside of your comfort and what your plan would suggest that you do. And these are also the fundamentals and guiding principles that are going to help you as you look at the print, say, all right, this is working, I'm long, buyers are stepping in. If buyers are truly stepping in, then price should move to this level and help you to hold to those targets. So some of the truths, and again, I want to get through this so we can actually start looking at the print. Some of the truths, a trader, I don't care who you are, a trader trades for profit, that's obvious. Most retail, in fact, any retail trader that I know, they cannot move price. Only buyers and sellers, again, the active market participants, can move price. Now, you're going to hear me say this over and over again. It's not because I just like to repeat myself or because I want to fill the time. It's really important as a trader that you understand that you have perceptions. You look at bars, you look at candle bars, you look at price moving up and down, you look at order flow, and you make impressions and assumptions and conclusions based on what you are seeing. And it's your impression and your influence on what you're seeing and interpretation that can cause you to miss what is really happening in the market. And so for me to say this over and over is very important. It's the reason why when I look at the print is my truth. It is the one truth in the market that I can see and I can rely on. Doesn't mean every trade is going to work and that somebody may step in and prove me wrong, but I know that if I'm focusing on the print and not what I think is going to happen, I can be much more successful in my trading. You know that indicators cannot move price in any direction, right? So whether you're looking at Fibonacci's or MACD's or stochastics or any other custom indicator, they can possibly show you opportunity, but indicators aren't going to move price. It's still buyers and sellers. Your bias, market blogs, commentaries, forums, market gurus, if you listen to somebody and they say, well, this is going to go up, they're not going to move price in any direction. In fact, all they're going to do is create a bias for you. It's not going to help. The success or failure of any one of your trades is dependent on one thing, and that is all of the bids and offers made by market participants, active participants, that happen after you place your trade. And everybody gets this. Every trader that I talk to gets this. They say, well, of course. I mean, if I go long and buyers step in, then I'm likely going to win. If I'm short and sellers step in, I'm likely going to win. That's not necessarily true, because just by the fact that there may be an additional amount of buyers who are lifting the offer doesn't mean that you are necessarily going to win if you're long. And you have to be able to look at what's happening in the print to understand that once you're in a trade, is your risk increasing or is the trade working in your favor? Is what you expect to happen happening? And again, once you place your trade, you've kind of set your leaf in the river, and you're letting your trade go. The river will take your trade wherever the river is going to take, or the market's going to take your trade wherever it's going to take your trade, just like a leaf in a river. So you want to make sure that you are buying with buyers and you're selling with sellers. So if you look at those truths and you say, yeah, all of those statements were true, and if you follow the logic, you trade to make a profit, your profit or loss is completely dependent on all the trades that come in after you place your trade, and the fact that only active market participants, buyers and sellers, can affect price after you place your trade, then you should only be listening to or watching the buyers and the sellers, and that is in the print. Those are the only things that buyers and sellers are going to move price after you get into a trade. Nothing else is going to be able to move that price and make your trade win or lose. Nothing else is going to help you to manage your risk. Now again, I'm going to go over this over and over again, because what I know is a lot of people just want to get to their trades. Show me the trade setup, show me the trade setup, show me the trade setups. And what I will tell you is your first job as a trader is to be a risk manager, which means you can identify an area to trade and you get into the trade exactly where you want to get into that trade. But when you get into a trade, you better know where you're wrong, and you better take your stop where you're wrong. I've seen too many traders get kicked out of the business because they get into a trade or several trades, the market starts working against them, and they go into subjectivity mode, and they say, it'll come back, it'll come back, it'll come back. And they keep moving their stop, they keep moving their stop, and they get wiped out. They get wiped out really quick. By the time that we're done with this, using the volume profile and the print, you are going to be able to see why you need to put a stop at a specific spot. And if you get taken out, it's okay. The next question you're going to have immediately in your mind is, okay, I got taken out. What is happening next? Because what is going to happen next is going to determine your next trade. So what you're going to be able to do is you're going to be able to go into a trade knowing that you've defined your risk, and even if you do get taken out in your trade, you have another trade behind that, because the market is likely going to give you some information about what it's trying to do. So which one's more likely to make a trader profitable? It's, of course, listening to the market. It's not just being able to read the print, it's being able to trust the print. You have to be able to trust what it is. I mean, I will tell you that OFA has built, in my opinion, the best tool out there to be able to read the electronic auction. It is all you have is truth. So you need to be able to rely on it and trust it for your trades. So I want to get in looking at an actual auction from today. Just a few guiding principles that require some explanation. You understand that buyers create demand by making bids, and sellers create supply by making offers. And then price movement just follows the simple rules of supply and demand. There are never, ever, and DB has said this before as well, there are never, ever more buyers or sellers. And I've heard this a lot from a lot of experts. The market moves from balance to imbalance and back and forth. And we're going to talk more about that and why this is important as we get into looking at probe and rotation and the specific print. The market is composed of different time frame participants with different objectives. What that means is I am a day trader, and sometimes I'm a scalper. And a scalper has a different objective than a day trader, right? If I'm a day trader and I'm trying to catch 5 or 6 points or more on the ES, especially coming in August, I might have to be in a trade for hours. Whereas if I'm a scalper, I may be in a trade anywhere from seconds to minutes or 15 minutes or something like that. And my objective for the trade is very different. And my objective for the trade is very different than the institutional trader who buys at a level and then sells at a level, price comes back down, and then buys again and sells and start managing their profit by selling as they are into profit. And their time frame for the trade may be weeks or months. So the point is that every market is composed of different participants with different objectives. And the cool thing is that the volume profile over time is going to show us those objectives, and it's going to show us the interests and fair and unfair prices for the different time frame participants. And what we're going to see towards day 4 and day 5 is when we can start lining up and getting some confluence between these different time frame participants, and I'm going to show you how to do that. You have amazing confluence for trades. You can identify areas for trades that are going to provide you excellent risk reward. So understanding that the different time frame participants make different swings in the market. So my scalping and high frequency trading creates a swing of maybe 3 points in the ES, whereas a day trader may create a swing of 6, 7 or more points in the ES, and the longer term traders will create 50-point swings in the ES. Understand that and understand how it relates to the volume profile, and you can start building trade plans that line up with those different time frame participants. Last thing here is, this is really important. Price will continue to move in a specific direction, either up or down, until the other side steps in and shuts that movement off. So price moves up until buyers have had enough and sellers say, nope, there's value lower. And that happens in many different time frames throughout the day, throughout the week, et cetera, et cetera. It's what creates a trend. It's what creates our breakouts as the market probes to new levels and gets back into balance. It's what creates the balance and imbalance. So again, buyers create demand by making bids, and sellers, we're just going to go through a little bit of detail here, and then there's supply. Supply by sellers, demand by the buyers. When supply is high, demand is low, price will move lower. This is the basic function of the market. When supply and demand are equal, price will rotate or be range bound, right? So what does that mean, supply and demand are equal? That means that we have rotation in a market. There are specific trading opportunities when the market is in balance. Those trading opportunities are different than when the market is probing new prices. And to understand where those levels are using the print and volume profile will give you different strategies for trading. When supply is low, demand is high, price will move higher. Now some of that's hard to make sense of, so I have a graphic here. When we have aggressive sellers, and we have more aggressive sellers, then not more sellers, but we have more aggressive sellers, price is typically coming down. When we have more aggressive buyers, then price is typically moving up. When we have an area where price is being accepted or there is balance, we have price that rotates. And basically this is a simple chart of supply and demand that creates or is generated from the order flow. And as buyers become more aggressive, their conviction level is higher. What do we want to be trading with? We want to trade with conviction. We use the order flow, we use volume cluster analysis, we use momentum to identify conviction in buyers and sellers. And when conviction gets higher, we can see it in the print, we can see it in momentum, we can see it in the cluster. When their conviction gets higher and they're actually able to start moving price, we know that we can begin trading with them, and we are likely to succeed in our trade. So how do we use it? Well, you'll often hear the phrase, there are more buyers or more sellers. I hear it all the time. I hear it on even CNBC. And a lot of people believe this. Price goes up because there are more buyers. Price goes down because there are more sellers. It really only demonstrates how much they really don't know, because the auction doesn't work like that. There are never more buyers, never more sellers, and the quantity of buyers and sellers has nothing to do with price movement. The auction is incredibly efficient in this sense. It requires one buyer for every seller, every transaction, so there can never be more buyers and more sellers. So if it's not the quantity of buyers and sellers, then what moves price? Now, a lot of you know this. What does high or low demand mean? What does it mean to you in your trade? What does high or low supply mean? Why do you even care about that? And this is one of those things I would want you to write down, not because it's on a test and you want to do well on the test, but this is really important. It's foundational to everything else we're going to go through in the week. So if you take one thing away from this morning, make it this, because this was my aha opportunity. This was my aha moment as I started trading so long ago using the auction process. And that is, it is the type of buyers and sellers that moves price, not the quantity. Why do you care? Because remember, you're into a trade to make profit. So what do you care? We understand that only buyers and sellers can move price, and they need to move price in the direction that you care about. And if it's the type of buyers and sellers, and you care about price movement after you get into a trade, then you care about how the bids and the offers are coming into the market. And when you can see what kind of buyers and sellers represented by bids and offers, also supported in volume cluster analysis and in momentum analysis, and in the volume profile, when you can see how they are coming in, you have immediate market feedback before and during your trades. Again, there are never more buyers, never more sellers. There are only aggressive and passive ones. Two types of bids, two types of offers. And again, I'm kind of going through some of this quickly. If you have a question, please go ahead and ask. But I don't assume that everybody really gets all of this, especially if you're new to trading the auction process. So I go through this to make sure that we're all at the same place. Two types of bids and two types of offers that represents the two types of buyers and sellers. We have a limit bid and offer, and the limit, or called otherwise known as resting bids and offers, represents passive buyers and sellers, lower conviction. Now, the one time that's different is when these passive buyers and sellers, some people know them as iceberg orders. This is where some people might say dark pools come in, where a big buyer or seller is standing at a specific price and absorbing everything that the other side dishes out. No problem. Limit orders still cannot move price. Limit orders are low conviction. When we see buyers are selling, holding the effort of the other side, then it gives us some information and we know what to start to look for relative to price movement. Market bids, they offer, market bids and offers represent aggressive buyers and sellers. They show high conviction. And basically the market orders are the one side, buyers saying, I'm willing to pay more. Sellers are saying, I'm willing to take less. Again, limit orders cannot move price. So when you're looking at a dome, I don't care if you're looking at level 1, level 2, if you're looking at a dome, those are all orders that are resting, they're sitting there, they're waiting to be filled by market orders. This is what we look at when we see orders executing at the bid, executing at the offer. But they don't move price. They can hold price, but they're not going to move price. Okay, it doesn't mean that they're not important, because they are part of the auction, and they're very important. But market orders are the only type of orders that moves price up and down. It's why in the print we look at the print relative to the bid and the offer. And when OFA does its weakness and strength comparison, it is always comparing prices at the bid and the offer. It's why we never look horizontally at price at any given time to see the relationship between the buyers and the sellers. Market orders, those orders that are filled at the bid and the offer, are the ones that move price. Those are the ones we care about. That's what's related and shown in the print, and that's what we want to pay attention to and base our trades and our trade management on. So since we make or lose money based on price movement, then what kind of orders do we care about at the time of trade entry and during a trade? Obviously market orders, or orders traded at the bid or offer. It's also what we're going to start focusing on when we start talking about order management or trade management and risk management. We're going to start focusing on the print. And what I'm going to go through with you is, once we start identifying trades, we're going to watch the print to give us our confirmation that the opportunity is there. Once we're in the trade, then we're going to use the print and what's happening in the print between buyers and sellers to tell us, is the risk in our trade increasing, or is this trade working in our favor? When you can learn to do that, what I will tell you is you will find your psychology, whatever that means to you, your comfort in trading, your understanding of what's happening in the market, and ability to remain objective will significantly improve. Significantly improve. Because you are focused on what's happening at the bid and the offer, and you can clearly see, it doesn't mean you have to get out of a trade, but if your risk is increasing, let's say you are short, you go short at an area, and the print tells you and it confirms that, yes, the buyers have stepped away, we have more activity at the bid, sellers seem to be stepping in, there's more activity here at the bid. If you're going short, buyers are stepping away, then what do you look for in the print? What changes in the print to tell you, okay, this is changing, my risk is increasing? Doesn't mean you get out of the trade. No, sometimes you need to let the trade work a little bit. But you understand, you'll be able to understand my risk is increasing, and you'll be able to do something about it. So if you're managing a very small account or a smaller account, you can effectively do something before you potentially get stopped out. If then the print then changes back into your favor, you can always get back into the trade. But the point is that you will always be in control, and you will be objective about your trade management and your trading. Very important. Once you're able to do that and you have that control, I'm telling you, your trading will change forever. Once you feel that control, and I've lived this. I know this. I spent a lot of time in a lot of different systems trying to catch a bunch of answers, right? This is the trading system. This is the solution before I got into market auction. And I remember sitting in a trade many, many times, and I would put the trade on, and I would just hope, oh, please work, please work, please, please, please work, please work. I had no idea if that trade was going to work or not. I had no idea if once I got into that trade, my risk was increasing or things were working in my favor, except for watching painfully tick by tick by tick. And if you're trying to make a decision on your trade based on tick by tick by tick, you will always be a subjective trader, and the psychology will overwhelm you. You will second guess yourself every single time. So this is why when we talk about going through psychology, I want to make it really clear that as we go through these fundamentals, as we go through understanding how to read the print, how to relate it to the volume profile, using volume cluster analysis and momentum, how understanding those things and always bringing them back to the fundamentals are going to help you maintain objectivity. And understand that you don't control the market, you don't control price movement. All you ever control in your trade or getting into a trade is you. You can control your risk, you can control when you take profit, you can't control price, you can't control price movement. And once you understand that, and you can start saying, all right, my risk is increasing in this trade, I need to, I'm making a conscious decision to manage this trade, or I'm going to let it go, but this is where I'm letting it stop. I want to see what happens at this level, one more price rung higher, and if it does this, then I'm going to get out of the trade, or I'm going to manage the trade this way. When you can start doing that, and you have that level of control, because you are fundamentally understanding what's going on in the auction as you get into your trade, then regardless of the fact that you really don't have control over price, your trading will change because you will have control over yourself. And once you finally get it, once you finally understand that your only control is really over yourself and your own trade, then you understand where your control is. You're able to be a much more objective trader. Now, I'm going to talk about that again and again and again, because from a psychological standpoint, all of these tools, as you will see, work together. And if we get through, well, we'll get through this by the end of the week, but when we get through this by the end of the week, you are going to be able to see how all of these pieces fit together to help you be an objective trader. Now remember, always two prices to consider. They're the bid and the offer at any given time. The gap between them is referred to as the spread with the ES. It's not significance. It's basically a quarter of a point. But simply enough, the spread is the difference between the price that a buyer wants to pay and the price that a seller wants to sell. Naturally, buyers want to buy at a lower price. Sellers want to sell at a higher price. So they make more money. So what that means is that when buyers place market orders, they're saying that they're willing to pay more. I'm a buyer. I have so much conviction. I think price is going up. I'm willing. I need to get into this trade. I'm going to pay more. I'm going to go up to the seller. I'm going to take their offer. And when sellers place market orders, they're saying that they're willing to sell for less, right? I'm a seller. I really want to sell at this price, but I really think that price is going down. I want to get into this trade. I'm willing to take that buyer's offer for less. They're considered aggressive orders. They show conviction by buyers and or sellers, and it's why we track those in the print. So basically, they have so much conviction that either price is going to move up or down in their direction. They're either willing to pay up or take less for their order. The result of buyer and seller interaction is that price moves up and down in two phases. And we've talked about this. The market moves from balance to imbalance. Every single market does this, from balance to imbalance. Balance is where price rotates within a certain range over a specific period of time. So the balance within a day time frame, even within the morning session or afternoon session, may be different and likely will be different than that over a week or over a month. But within a day, and once you start understanding these principles, okay, right now price is in balance, it's in balance, it's in balance. I can see it's in balance because of these characteristics of price movement. I can see it's in balance because at the top of this range, I have buyers going away. I have sellers stepping in at the bottom of this range. I have the bid getting weak, the offers getting strong. I'm in a range. The price is in balance. So what am I looking for? Well, I'm either looking to trade in this balance area at the extremes, or I'm looking for price to start moving out of balance and start seeking new prices. And price shows to be in balance for one of two reasons. It's either building price acceptance for further continuation. This is what happens in a trend. Price moves up, it builds balance, it builds acceptance, or down, and it keeps moving up, and remember, price will continue to move in a specific direction until the other side steps in to shut that movement off. So when a price moves to a new level and it begins to balance, what it means as a trader, because you understand the fundamentals, is okay, price just went out of balance. It's now in an area, it's rotating. Now intraday, that may be for, on the ES, it may be for 15 minutes. In some cases, especially in the last couple of weeks in August, it may be 3 hours that price is rotating in a specific area, getting balance. But your job as a trader, because you understand that the market moves from balance to imbalance, is say, okay, the market's in balance. My trade opportunities are in this balance area. Is this something I want to take? If so, what am I looking for in the print to get into this trade? Knowing that my range in terms of profit is within this balance area. But what do I know as a trader? Well, I know that the market's likely to move out of balance. So I make a conscious decision to say I'm trading in this balance area. Once price starts moving out of the balance area, what am I looking for in the print specifically? Number one, to make sure I'm not just going to get stopped, and that may happen. But what am I looking for in the print specifically to know that the market is now moving again into discovery mode and looking for a new price? The other reason that price shows to be in balance is because the other side's stepping in. They're holding the continuation. Let's say buyers are pushing, and sellers get to a point where they say, nope, we start to see value lower, and they hold, and they keep the buyers from moving higher. What we're going to see is that the market will start to balance and then start to move lower again. Now, imbalance. This is where price is in discovery mode of new prices. They're basically, again, two phases in just about every market. Price is either in balance, or it's in balance or out of balance, and it's in price discovery mode. There are two scenarios for price discovery mode. After it, you get acceptance of price, and so the market moves into balance, or you get rejection of price, and you start getting responsive selling or buying. Responsive selling, responsive buying is in response to price movement. And you can see the reaction in the market, and we're going to take a look at what that looks like in the print. Just to look at responsive buying and selling, it's not just in the letters that pop up above and below your bars. The volume profile in the print will help us to understand which one is happening, and we're going to go through that. So what's interesting is we think about balance and imbalance. Balance areas are evidenced by price rotation. Imbalance areas are evident by buyer-seller probe moving into new areas or to an extreme outside of balance. They are pushing, they are testing. In a lot of cases, if price is moving higher, buyers took out sellers. And if buyers just took out sellers, either one of two things happen. We're going to get into this later. Either it's a stop run, right? It's a short-term play, and those buyers saw a bunch of stops above, and they let price move up, and they took out they took those short-term buyers out. It was a stop run, and they moved back in. So one of two things happen here. Balance areas, again, evidenced by probe into new areas, and as it moves outside, it's either going to be a stop or price is going to move and seek new balance area. So if, for example, buyers are taking price higher, sellers have been coming in, it's been rotating in balance, we can see sellers have been hitting the bid as price hits a certain level, and now buyers take it through that level, the volume profile is going to show us, is this a real move? I'm going to show you how to look in the volume profile. Is this a real move, or is this a quick stop run? And what the probability is of it either being a stop run, what to look for in the print, what to look for in the volume profile, to say, no, this is a stop run, I need to be prepared to go short again, or, yep, this is a real move, we're likely to move into new areas, where's my next likely opportunity for price to go to? So you can take advantage of that trade. What's interesting about all this, at least I find interesting, is the result of the market auction are natural movements of probes and rotations. And it gets us into order flow. So it's not by accident that the foundation, the OFA framework, is probe and rotation, because that is what the auction is. The auction in every market is a series of probes and rotations. Now in the ES, we'll see that nuance is a little bit different, actually quite a bit different than instruments like the TF and the CL, where we have much thinner volume, and we can see a range of 50 to 100 plus ticks on oil, which might be a full 10 points on oil, whereas with ES, we're going to see a much smaller range, likely to see a smaller range of 20, 30 ticks in a day. So the probe and rotation settings, we need to understand them relative to the instrument that we're trading. But again, it's no accident that the foundation and framework is probe and rotation, because again, it is what the auction is, and it's the best representation of the auction, the electronic auction. So we're going to begin our discussion of order flow with the importance of this framework as well as the indicator. Now the activities of, let me just stop here and see if there are any questions so far. If you have any questions, I want to give you an opportunity to ask that. Again, some of the key points that I brought out that I want you to write down, that I really want to highlight, is that the market is an auction. And the auction means that we have buyers and sellers engaged. And I don't care if it's high frequency trading, dark pools, doesn't matter what it is. It is buyers and sellers engaging. Even if it's the same entity, just different offices, one's buying, one's selling, and taking advantage of the order flow and liquidity in the market. That happens as well. They're still buying and selling, and they begin to show in the print and in the volume profile what their intentions are. Where is fair price? Where is unfair prices? So the buyers and sellers, they make the auction, they make up the market. It is these buyers and sellers that are going to move price in our favor or against us. They're going to make us win or lose. So it's important that we understand what they're trying to do and how good of a job they're doing on either side of the bid or the ask. We need to put that into context of the overall market and the overall instrument that we're trading in order to find opportunities. Now, some people like to fade trades. They like to take trades in the other direction. Other people love to trade trends. And understanding what the conviction levels are and weakness levels are of the buyers and sellers are going to help you, and looking at the volume profile are going to help you do both. So again, just to summarize, buyers and sellers, they create the auction. The auction is represented by this thing called order flow in bids and offers. And those bids and offers create structure in the market that over time tell us what the buyers and sellers are trying to do, and more importantly, how effective they are in trying to do that. So if we can see in the print, we can see in a structure chart with volume cluster analysis and momentum, that buyers are in fact getting aggressive, and we can see the volume coming in. What we're looking for is, can they actually move price? Because inherently we should understand that if they can't move price, then there's a likelihood that price will come in the other direction and all of their activity will likely stop them out. So it's two components. We want to understand what buyers and sellers are doing, where their conviction levels are, and then as we look to get into trades, how effective is either side in achieving their objectives and moving price. And it's only those buyers and sellers that actually is going to take us to profitability. So any questions that you all might have before I move on? Because we're going to start getting into the order flow and the probe and rotation settings and things of that nature. Oh, I didn't see all my questions. Let's see. Let's just take a few of the questions. On a macro basis, you can have more people entering the market with intention to buy than with the intention to sell. On a macro basis, intention to buy is a limit order, and intention to sell is a limit order, which is correct, Peter. You can have more people with intention, again, limit orders, getting ready to go in to buy than to sell. And again, what moves price is what buyers and sellers actually do when buyers move up in the offer to take the offer, or sellers move down in the bid to take the bid. And Alan, for some reason I hadn't seen the questions when you said, can I show previous slide? If you could just let me know what I was talking to, I can certainly get back there. I say the market moves from balance to imbalance at the extremes. How do you know it's an extreme? Great question, Roberto. I am going to show you that in the volume profile. It's one of the elements of the volume profile, which I call a finish to an auction, one side or the other. And in fact, as we kind of go through in days 4 and 5, and we start getting actually into the market, based on the print and based on the volume profile, I'm going to talk about things like, okay, this auction is finished to the upside. So this extreme to the upside is done right now. This extreme to the downside is done right now. And what's going to be really cool is the volume profile is going to give you a strong visual signal that an auction is at an extreme and may be ending. I hope I answered that question. I was making notes on the slide, which you said was most important. Could you show it again? Yeah, and that slide, the most important piece that I talked to before was that the essence of when you get into a trade, the only thing that is going to make you successful are all of the orders, and specifically market orders, that come in after you enter your trade. So let's face it, if an indicator tells you get into a trade, if you're not watching the print, let's say it tells you get in long, and you're not watching the print, I mean, let me just see if I can put this over here real quick, just to give you an example. No, we don't need to get into that right now. I can see weakness at the offer up here. If an indicator told me to get in long at 23.50 because it was some, here was some buying, and I can see activity coming back in at the bid, right now this trade would tell me that I'm at risk. My trade is additionally at risk because I'm getting more activity at the offer. What I want to, or at the bid, what I want to see is the bid go weak and the offer start to get strong again. So by understanding what's happening at any given time at the bid and at the offer when I'm in a trade, because this is the only thing that matters. This is what's going to take my trade. Let's say my long here in front of this cluster here at 23. The only thing that's going to take this into profitability is what happens after I get into that trade. So what I really care about is what is happening at the bid and the offer after I get into this trade. I can see sellers trying to push price down harder, and I can still see activity coming in at the bid here at 23. If I'm long in front of this area at 23.25, I have an indicator that tells me to get long, and I'm just using this as an example. As I'm reading this print, this starts to tell me, especially with this momentum, neutral auction, selling volume cluster, my trade is at risk. I better manage this trade, take a little bit of a loss, manage this trade. If the print tells me something different, I can get back into the trade. But everything in this auction, once I would get into it, starts to tell me that my trade is at risk. Once I understand that my trade is at higher risk, I can begin to do something about it. And I can manage effectively. And most importantly, I can manage objectively. I don't know what's going to happen next in the market. I don't know if buyers are going to step in, some news is going to hit, and price is going to take off again. But once I'm in a trade, this is my truth. And once I start seeing additional risk happening against my trade, I can effectively and objectively manage. And again, I cannot stress to you the importance of this. And again, it's one of the reasons I am so happy to be doing this with OFA, is because its strength and weakness algorithm at the bid and the offer is what helps me manage my risk. The other things like the volume clusters and the momentum additionally help me manage my risk. So the most important thing that I was going through is once you get into a trade, it is all of these buyers and sellers that are going to take your trade into profit or into loss. And like with this trade, let's say, I got in at this level here at 23.25. It's coming down against me. I move my stop. I say, oh my goodness, this is bad. It's coming down against me. It's got to move up. It's got to move up. It's got to move up. And I keep moving my stop. There is nothing in this auction right now that tells me I don't have continued risk in this trade. Yeah, relative weakness down here at 21.75. But the risk has already occurred, and actually, as I look at this, the potential for this to come down to 21.75 and lower is pretty good. I mean, maybe even all the way back down to 21.25, which was we're going to get into this later in the day. This was the closing swing high for Friday at 21.25. So the most important thing that I talked to was the fact that all of the orders that come in after yours are what is going to carry you to profit or to loss. You need to fundamentally understand that before you get in the trade, and you need to fundamentally understand that once you're into the trade. If you understand that prior to getting into the trade, you're going to make decisions based on buyer-seller interaction. It doesn't mean that you will always be right. But what it means is that you're going to have a lot more control over yourself, which is the only thing you have control over. And when you have control over yourself, relative to what buyers and sellers are trying to do, you become a different trader, a much more effective trader where you're significantly managing your risk and letting trades move to profit. Let's see. So I hope that was helpful, Alan. I'm going to go through a few more of these questions. Will we learn how to set probe and rotation for different markets? Yes, I'm going to go through that this week. We're going to talk a little bit about it today, and we're going to go through that this week, especially as we start looking at some of the other instruments. I will show you how I set my probe and rotation differently and why I set probe and rotation differently. Oh, absolutely, Michael. Glad that this is helping. Thank you for explaining the market auction process. Here, for me, and this is why it's so important for me to train this, the level of aha and for me, not just in understanding the market auction once I got it, but the level of effectiveness in my trading that it provided for me was monumental. If there was ever a point in time that I could point to in my trading that said this was the change, it was understanding the fundamental and the principles of the auction. So it's why I spent a lot of time here, and I'm glad to do it. Thank you for the comment. Will you be able to identify spoofing in the OFA print? If you mean spoofing like a stop run, then Nestor, what I would tell you is I'm going to show you using the volume profile and the print how you can identify when a stop run is likely occurring. When is a stop run likely occurring? How can you identify it? And more importantly, what to do so you're not frozen in your tracks. Hard copies of the slides, I'm not sure. I can certainly bring that up with DB. And yes, the recording will be available, and that's great, Ray, great question. Recording will be available. I encourage you to go through it again at a slower pace and take notes. That's awesome that you want to do that. And let's see, when I say, let's see, recognizing extremes, is that the same thing that DB called a leading base in past training? Yeah, I don't know how to answer to that because I'm the context of leading base I'm not quite sure of. When I talk about an extreme, I'm talking about a, he says no, that's kind of what I thought. I'm talking about a test, a probe into an area where price has not been before. Buyers or sellers are testing, they're probing into an area, into an extreme of the day for a month, et cetera, et cetera. When I say weak, am I referring to the colors, the math differential of the prints? Yes. And you know, one of the things I truly, and I don't just say this because I'm working with OFA, it's the reason I'm working with OFA, the thing that I love about it is their algorithm and the fact that I can customize my colors so that I can take more thinking out of trading and I can react to what I'm seeing because it is doing the work behind the scenes once I've set it up. I love it, I love it, I love it because trading takes a whole lot of concentration, especially when you trade reading the print and using order flow, because it's a lot of numbers to be watching. When I can find an area and I can identify what a market is trying to do and rely on the colors and the software to tell me if my scenario is occurring, where I don't actually have to read the numbers, I can see strength and weakness. Oh my goodness, it was a complete release of focus that I didn't have to have anymore, and I could start looking at the print once I got into a trade. So yes, yes, and yes. When I say weak and strong, I'm referring to the colors of the math and the differential of the prints. Okay. Spoofing relates to the dome. Yeah, okay, I understand what spoofing means. When you've got a lot of ghost orders sitting out there in the dome, and as price starts moving up towards that price, the closer it gets, they take them away. Yeah, that's one of the reasons I really don't put a lot of my trust in the dome because of spoofing. It's possible. I think the only place, in my opinion, the only place that the dome is appropriate and useful, and this really you need kind of level 2 data. The only place that is useful is really to once you have a balance area, and for example at the top you can see buyers, or at the bottom you can see buyers, top you can see sellers. If you have a lot of sellers at the top of a balance area, and you know sellers are selling, and you can see a lot of limit orders at the buy at an appropriate stop level, then the second level dome information, those limit orders are probably stops, and as they keep growing, as the longer the rotation happens, those are likely valid orders. So That's the one place I would say is there's some value there. Right, follow the print, not the orders. Follow the print. Always follow the print. And again, it's why I'm spending so much time here, is because the print doesn't lie. And again, is one of the things you're going to do as you go through this is, again, you're not going to win in every single trade, but one of the greatest benefits to trading this way and learning to trade with the print and understanding that buyers and sellers control price movement is when you focus on the print and you say, this is my truth, this is my truth, this is my truth, and you let them tell you what's happening and you become objective, you will start to see and feel a greater sense of control in your trading than you've ever had before, because you will understand what to do when buyers and sellers are telling you something. Again, you get into a long trade, it doesn't mean that you get out of a trade if there's more activity at the bid. And we're going to go through this as we get into trades. All it's telling you is you get in long, and all of a sudden the price starts coming back, and you start seeing activity at the bid getting heavier and heavier. All it tells you objectively is, okay, I have more risk. There's more risk because there's more pressure. I need to make a conscious decision relative to my trading objective, what I want to do with this. Is it being held? What am I seeing in the offer? We're going to go through all that and what to look for in the print once you get into a trade. All right, very good questions. I just like to poke over at the ES, but we're going to get into that here in a little bit. So activity between buyers and sellers is what creates the order flow. And again, I don't care if it's high frequency trading, I don't care if it's institutional trading, retail trading, it doesn't matter. It's what creates order flow. And since only market orders move price, and we care about price movement, right? That's what we care about. Then we use the OFA tools to represent the auction or the prints traded at the bid and the offer. Now, there's this thing, you know, reading order flow, and everybody wants to be able to read order flow, read the print and read it. But what I would tell you is reading order flow is both a process and a point-in-time activity. So, for example, what I do when I'm trading the ES is I'm usually up, I'm on Central Time. I'll try to convert this to Eastern. I am up by 7 in the morning, 7 Eastern, 7 a.m. And I will look at the overnight and I will mark certain volume spikes in areas of interest in the overnight. And then what I start doing at about 6:20, 7:20, 7:30 in the morning to about 7:45 is I start looking at the auction, the print, the order flow, and I start looking for additional volume and US. We're going to go through this again, so don't feel like you got to take all the notes here. I start looking for the US market to start to get active and engage in the ES. And so I watch the print and I look at the volume and I see something in there and I say, oh, that's great. Here we have a little bit more volume here. I can see the US market starting to wake up and start to get involved. What's that doing? What are they trying to do and how effective are they in doing that? Oh, they're pretty effective. Their price has been moving lower. I can see buyers stepping in while they're holding price. Something good to know. Now I'm going to start watching as more and more volume starts coming into the market. We have this pre-market session that goes on all the way up to the U.S. market open. And by the time the market open happens, I have a pretty good sense from reading the print, at least in the pre-market, what the U.S. buyers and sellers are trying to do to price. Right? So it may look like in the print, as I read it, it looks like buyers are holding. It looks like buyers are active. They're engaged. And so what I'm looking for now in my trade plan is I'm looking for a level below in which I can take a long, a potential long. Now I'm still going to go back to the print and identify that the print is confirming a long, but I'm using it as a process. I'm using it as a process to start to look at, all right, I see some volume coming in. I see the cluster analysis. I see what the effect is on price. I see where they're holding. Okay, this is what it's telling me. And so once I get to the open, you know, it's sometimes even prior to the open, I have a pretty good understanding of what they're trying to do. And if it's different than what I've read up to that point, then I can do something with it, right? If price comes to an area where I'm looking for a long because everything up to that point has told me that buyers are holding, they're getting aggressive. When they get aggressive, they can actually move price, they're effective. And now I'm looking for an area to get long, so I'm looking for some level of test lower to get long. And the print confirms I can get long. If that changes and buyers all of a sudden get weak and they start relenting, I can effectively manage that trade. It tells me something about the day, and it tells me what my next step is in trading and in the market, and we're going to go through that. So order flow is a process, and sometimes it can be done in a point-in-time activity. So for example, when I'm looking to get into a trade, I've picked my level, right? Because I want to buy with buyers, I want to sell with sellers, but not just at any given time. I mean, if you look at the ES right now, let me get a volume profile up here. Now, 1 second. Let me just show this to you. Like I said, I like to use live data for teaching. So let me grab the volume profile. So what I can see, let me bring this over here. In the profile is, and we're going to go through the structure of the profile tomorrow, I can see a very balanced morning in the profile. And I've scrunched this all up to get all this on one chart. But I can see a very balanced profile. The volume point of control is down at 22 at this level, 22. And what that means to me is right now this is most fair price. And so this market is telling me right now that these participants are finding balance at this area, and we're in a balance area. We have rotation. So to tell me what my next trade opportunity might be, or what I might be looking for in terms of a trade opportunity. So the volume profile starts to show me structure. If I open up the prints, the print starts confirming that structure. So I can see weakness at the offer at the top of the range. I can see relative weakness down below. And in a balanced morning like this, what I would expect is price to move higher, price to move lower. So it starts showing me I have no opportunity. If I get in long or short right here in the middle, I'm toast. This could come back down here, it could move up there. So what it starts to show me are where my trading opportunities are and what I'm specifically looking for then in the print to confirm. I mean, and honestly, it's kind of this easy, as we're going to see, is we're going to identify our areas for trade. Trading in the middle can be difficult. We're going to identify our areas for trade. We're going to learn how to confirm in the print that the trade is there, and then we're going to learn how to objectively manage that trade. And if the print starts telling us we have more risk, I'm going to show you how to make an objective decision. There's going to take some practice there for you to be able to manage your trade effectively. But right now, this market is in balance. I see a pretty good rotation. The volume profile shows, we're going to go through a lot of this tomorrow, a very solid distribution of price. And this starts to identify where trade opportunities are for me. So my trade, like I said, the trade opportunities, I made a trade earlier today, actually last night. My trade opportunities really are up here or down here. When I look at volume point of control, which is actually now moved up almost in the middle here, 2375, I just simply can start reading the prints where I have opportunity or where the market gives me opportunity. This is point in time print reading. Reading the market or reading the print as a process is something different. That is taking a look at, for example, I can see sellers here. I can see in the print, and we're going to go through this, but just I want to give you a live example. I can see in the print sellers really pushing, really pounding on the bid. They went weak, moved all the way back up, moved up to the top. They went weak. Buyers went weak. I have a market right now in balance. I have no trade opportunities in the middle. Anything in the middle is a risk. My trade opportunities right now are on the edges. So when we get to an edge, my using the print as a process tells me I have balance. Using the print as a specific tool tells me I have trade possibility. For example, right here, we had weakness and strength at the bid and the offer, right here. And I would be trying to manage this trade back up to this area, taking some profit at the VPOC. So the reading the print, and a lot of people talk about, reading the print and using it a lot of times as a point-in-time activity. However, what I will tell you is that reading order flow as a process, especially when you know when to look at it and what to look for as buyers and sellers get aggressive, you can really identify the other side of the question. Is there two questions you're always asking in trading. What is this market trying to do? And by the market, I mean buyers and sellers. What are they trying to do? And you can see that in a structure chart. You can see that in, you can even see that in a candle chart. What are they trying to do? Our price is going up. Okay, they're trying to bring this higher. The second question is, how effective are they in doing what they're trying to do? And the best way that I found in actually determining that is using order flow as a process as you're going. You're going to look at it anyway, but as you go through the day and you look at where buyers are getting strong and where sellers are trying to get strong and where they're pushing more volume, watch how effective they are in actually moving price. And that's going to tell you a lot about what the market is trying to do and how effective they are in doing it. And if they're effective, guess what? You're likely to have a trend. You're going to have a trend. You go back to one of your guiding principles that says price will move in a specific direction until the other side steps in to shut that movement off. So if I can see sellers coming in, pounding the bid, and they're actually effective at moving price, then I have sellers being effective in some form of a trend, and I know price is likely to go in that direction until the other side steps in to shut that movement off. So what am I looking for? Well, number one, I'm looking for a short opportunity, possibly on a pullback, and I'm looking for responsive buying. I'm looking for the other side to step in and hold and start to prevent sellers from actually making progress. When that happens, red flags go up in terms of risk to the downside. Doesn't mean price won't keep going down, but as I'm reading the print, that tells me, oh my goodness, we have buyers holding. Any further movement to the downside might be at risk here. Or I need to keep watching. If it comes down and I see more responsive buying in terms of actual price movement, I know buyers are stepping back in, especially if it's at a level I'm looking for buyers to step in at. So again, reading order flow, it's a process and it's a point-in-time activity. And as I use it as a process and I confirm with the volume profile, it not only gives me places of opportunity, but it helps me confirm when it comes time to looking at point-in-time activity in the print. It helps me confirm if that order that I'm placing is a good order, a valid order. And I would tell you right now, ES just moved back down to the bottom of the day, and high probability that price is coming through the bottom for those of you who are watching the ES. And we're going to go through that and why I can tell you there's probably about an 85% probability that price is coming through. I don't know if it's a tick. I don't know if it's a point. I don't know if it's 10 points. High probability that price is coming through the low on the ES right now. And we're going to go through that. So let's see. Yeah, I will go, Michael, I will go through all of my chart settings. Absolutely. The other thing that I will do is make my my templates available. Yep, so you can have all of my templates too. Very possible a settlement test. That is correct. I have a Just for your information, I have the closing swing low on Friday was at 1918, and I would look for buyers to step in between 1918 down to potentially 1725 level. So, yep, you are welcome. Yeah, it's not just my goal, but and this is why we're going to do some follow-up sessions and you know, like I think DB talked about, and I already have put some videos out there. I'm going to keep recording and posting my videos. And as I said before, I think I said to Friday's class, it doesn't matter if my videos are a year old or 6 months old or from last week. When I do a video, I show you what I'm looking for, what my context is, why I'm getting into the trade, specifically what I'm looking at in the print. They're all relevant teaching pieces of information. What it isn't is, hey, this is right now at 10:38 Eastern AM where I'm expecting price to go. But they're all relevant teaching materials. And the reason is because as long as the markets have existed, they've always been auctions. And the principles of the auctions have never changed. So it's always been a push-pull relationship between buyers and sellers. And when buyers and sellers are active, and you can see it in the print, it doesn't matter if the lesson was from a year ago or a week ago. It's the same lesson because the same fundamentals apply. And once you get that, once you understand that, then you can start really taking, it tells you understand the principles, and you can really start taking this into other instruments. All right, so I've spent a lot of time on reading order flow as both a process and a point-in-time activity. The process of reading order flow provides context for a developing day. When I talk about the process of reading order flow, again, that's me talking about, hey, I'm looking at buyers and sellers over time. I'm looking to see where volume comes in, and I've got a super simple tool. I mean, you won't even believe how simple this is. Just to give you a flag, a heads up when volume is coming into the market. It's not going to tell you. It just is a flag to go look at your print. That's all it is, and we're going to go through that. So the process of reading order flow gives you context for the developing day. It allows you to look at the volume profile and say, oh, I totally understand why price did what it did. I understand what buyers and sellers are trying to do on this day, and it makes a lot of sense because you're going to get confluence with the volume profile. So reading order flow as a point-in-time event, again, is for trade entries and trade management. So again, reading order flow, two things: getting context to identify trading opportunities. And when we talk about reading order flow as a process, we're talking about how effective are these buyers and sellers being. It's a second part of the question. What are they trying to do and how effective are they? Order flow provides that context, and then point in time is relative to entries and trade management. Okay. As a process for context, right, we use order flow chart and a structure chart and the volume profile to gain an understanding of buyer-seller effort and, again, effectiveness. How effective are they in actually moving price? When you see effectiveness, when you see buyers being very effective at moving price, especially on maybe lower volume, that tells you that you want to look for a likely long. You know, you're looking at the volume profile. As long as you've got room and you can see that the market isn't, buyers aren't done to one side, and your best opportunity is going to be on a pullback, and you want to look to jump on a trend. A lot of times we won't know if a trend is starting, but we all know the trend is your friend, and there are some people who just love trading the trend. This is where we get context for that trend, and then we use the specific order flow chart to get us into a trade to take advantage of that trend. So in addition to the order flow, OFA provides at least what I feel two other very important indicators. I've talked about them. They're the volume cluster analysis and the momentum analysis. So as you're looking at the print and you start to begin to understand how to get context of what the buyers and sellers are trying to do and how effective they're being, now we take these other two tools, which are the volume cluster analysis that takes in any given bar, the majority of the volume tells you, is this buying, strong to the buying or to selling, at the bid or to the offer. I don't want to say buying and selling, but is the strength here at the bid or is the strength in the offer? Here's where the majority of the volume is, or is it neutral? So it helps you understand what's critically important, which is, and I know DB has talked about this a lot, where is volume coming into the market and what kind of volume, what's it doing to the market? And not just buy volume, sell volume. Volume that's coming in at the bid, strong. Volume is coming in at the offer, strong. The volume cluster analysis gives you additional information relative to where volume is coming in. And that will help you get confluence with the volume profile chart. And then the last one is momentum analysis. If you're expecting buyers and sellers based on what you're looking at to get aggressive and stay strong, get momentum in a specific area, the momentum analysis helps you confirm that without having to go through the print and say, okay, strong, strong, that was weak, strong, that was weak, okay, okay. It allows you to do that visually. And again, with trading, there is so much information that you as a trader have to take in and interpret, and you can only do so much. Being able to go to the different colors, and I would tell you to be able to customize your colors so that they're meaningful for you, so that you don't have to think, you can just react to them, is it. I really don't have the words to tell you how important that is and how amazing it is to me, because it takes away further analysis that I have to do in reading the print. And when that's taken away, it helps me become more objective. It's like anything else, you know, if you go into a test at school or you go into a work job, a function, and you don't know what you're doing and they're throwing a lot of different things at you, you can become overwhelmed very quickly. Well, that's really never more true than in trading. And by the way, your own money is on the line. As a human being, again, your ability to think objectively, to look at data and interpret objectively, significantly decreases. So being able to adjust the colors, being able to have those two tools are critically important. And we're going to go through specifically how to use those. Not just in a structure chart, which is very important, but also in a profile chart, and compare that to the volume profile. Now, as a point-in-time activity, we use the order flow to determine if market participants' activity supports a specific trade entry and how to scale if we're going to scale, or where our stop is going to be. So what that means is, moment of truth comes, your indicator fires, you're at a level you want to make a trade, for whatever reason it might be, and you are, moment of truth, making decisions, push the button. The order flow is going to tell you whether or not to push that button. You've done the homework, you found the level, the order flow tells you, yep, you're looking to go long, the order flow tells you, yep, sellers are losing interest here, they're becoming weak, I start seeing strength back at the offers, buyers are starting to step in, I get into the trade. Does that mean the trade's going to work? No. That's when we use a point in time or reading order flow to manage our trades. Manage our trades. But what I can tell you is that it's kind of like the old saying that, you know, in golf where 100% of short putts don't go in the hole. I can tell you that 100%, well, maybe not 100%, but a high percentage of trades that aren't taken due to hesitation will lose. Because inevitably, because of the probe and rotation, price may work a couple of ticks. If you get in late to a trade, you found your level, it comes down, you go, you're in a point and a half away from where the level was, maybe 2 points, and you know, I could have already taken a scale here if I wanted to, but I'm getting in here, now it's moving against me. Where's it going to go? I really don't want to take a 2-point stop or more. Use the print to get into the trade. If you've done your homework and you've gained your context, then you have to let the print be your truth. There is no other truth that you have available to you. Everything else is just ambiguous and uncertainty. It's the only thing that you have. And it's the only thing that will help you from a psychological standpoint gain control and manage your trade objectively. I really cannot stress this enough. All right. Volume cluster analysis, again, momentum analysis. Let's take a look at both of these in a live chart. All right, we're going to go back over to our handy dandy friendly ES and take a look at what we have. I've already done a little bit of this where I've talked about using order flow as a process, right? And what did I show you early on? Here's the volume profile, and we had weakness at the offer up at the top, weakness at the bid, and we had what I would call a nice finish to both sides. We had a very good distribution of price movement, and as we get into volume profile, you'll understand what that means. Very, very good distribution, which suggested a balanced market. And so our trade was either at the edges, trading towards the middle, or waiting for what? A breakout of these edges, and for confirmation in the print that buyers or sellers were moving to a specific level. So as we looked at our print, and we're looking at the process, what starts to change back down here, and here is our level. We can see strength coming back, and there's no shame in this. We see strength start coming back into the print at the bid. Bid. We don't have any momentum bars yet showing us to the downside. And if you went short here, let's say you're going to take a breakout, you see a lot of strength coming back in at the bid just below that low, and now we're starting to get a profile breakout as well. There's a good potential you're going to get stopped out in that trade. You shouldn't take this trade too far. But what you're going to see right here at 2050, if you're watching the print in the next bar, is it's going to go against you a little bit. You're going to see weakness in the bid, strength at the offer. And once you learn to use this, that is immediately going to tell you, forget about what likely is going to happen in the trade. This is immediately going to signal to you that your trade is at risk. Strength coming back into the offer, your trade is at risk. Might have been just a stop run, but you're at risk this time. And it goes up. What do you see? I got weakness with buyers. Weakness, and more importantly, looking at the print, my volume point of control is at 23. I think at the time it was at 2350. So what am I looking at? And we're going to go through this again. What am I looking up at 2350? I'm looking for buyers to try to push this higher. What do I see in the print? Weakness, neutral auction, selling cluster, neutral. There's no strength to the upside. No strength at the bid. Where's my trade? So, and what you'll learn as we go through, especially tomorrow, is that if buyers aren't willing to take price effectively, and I believe at the time volume point of control was up at 2350, if this is no longer fair price for buyers, then buyers will need to find a different fair price. And if they want to make money and they've kind of given up ship here, they know they're not going to make money here, then the probability is that they're going to find a different place to get long. They're going to find a different place to try, and that's going to be lower. So the likelihood is the next time through this level, we're likely to see further movement to the downside. And remember, price will move in a specific direction until the other side steps in to shut that movement off. Buyers stepped in, they shut the movement off, but they had nothing. Nothing. How effective? This is the other part of the question. How effective are buyers being? Not effective at all. And again, I believe VPOC was up here at 2350. If they're not effective up here, and they were here, right? They were able to step in. The likelihood is that they're going to find another fair price, and that's not going to be up here. It's likely not going to be here because more than likely they want to make more. So we'll see them try to find a different price. And like I said, 1918 was the one of the things we're gonna talk about later in the day is opening swings and closing swings. And the closing swing low for Friday was right here at 18. And then we have a low volume area right at about 17.25, right where this red line is. So anyway, in reading this as a problem, I can see that buyers have kind of not given up, but they certainly have not proven that they have interest back above this this level yet. And in order for me to take any long, now all of a sudden certain conditions have to apply. They've kind of stepped in, but I don't see any conviction. I don't see the conviction necessary for me to take a long. So what it starts doing for me is enabling me to build. We're gonna go through this. All of this is going to culminate in building if-then scenarios. If price does this, then this is my trade. If price does this, then this is my trade. So it helps me to identify specific strategies now, and not just areas of opportunity, but trade opportunities and what my strategy is if that actually occurs, if my if-then scenario actually occurs. And so, again, as I'm reading the print, I'm reading weakness at the bid now, weakness here. And even though we have weakness at the bid, what I'm not seeing, and this is the other thing that helps me as I look at the auction as a process, is each one of these bars, and every time price goes between 1920 and 1975, you will see that there is a different relative strength and weakness in this set of bid and offer than here. Right? It's different here in this bar between 1975 and 1950 than it is here. Right? This shows relative neutrality. So what I'm also doing as a process, and this can just take a little bit of time sometimes, is to understand that the last time up here, we had activity at the offer and at the bid, somewhat neutral, but we had a little bit more selling step in, and then buyers held. So we have, as I read this as a process, I've got a level, beyond these buying clusters right here into this neutral area that I would look for sellers to start stepping into. Excuse me. But I don't see any continued strength to the downside at the bid. So what this is telling me is we have a little bit of a balance area happening between this 2050 down to closing swing low from Friday at 18. So this has been I had this drawn from Friday. This is a key level as well as this opening closing swing high at 21.25. And so what I would look for, and my mind is this, I also have a low volume area at 17.25, which I believe had some relative importance from Friday. 17 to 17.25. So I'm looking for additional weakness to come back into the offer down here, and what I actually might experience is a stop run down through here. I don't have a short potential until or unless price moves through this 17 area with momentum, and I see conviction. And then what we're going to learn is how to use the volume profile chart to say this has further extension and what the most likely area for price to go. So I would tell you that if it breaks through this level, we'd be looking for 1575 and possibly all the way down to the low of Friday, which was 1910.25. Not only is it looking heavy here in the print, but the volume profile would suggest that this has got lower to go. But I have a level here that's a key level where I would start to, where I would expect to see buyers step in here at 17.25. So what I'm able to do between the volume profile and the print relative to reading this, right? Because it came lower. As I'm reading the print as a process, even though price started moving back up, there was nothing in the print that suggested buyers were going to take this higher. And because of my guiding principle that says price will continue to move in a specific direction until the other side steps in to shut that movement off, what I'm looking for is, in my using volume profile, is where is the most likely place for buyers to come in and shut that movement off. And as I look at the volume profile, that place is down here between 17.25. If it comes through here, right, if it comes through this level, and I'd give it maybe a little bit of room here, but if it comes through this level with significance, momentum, and I can read in the volume profile that, and it isn't finished to the downside, that this is likely extending, then I have a short opportunity on a pullback if it will pull back to 17.1675. And this is, there it goes, 14.75. I think I said 15.75, and then this has potential all the way back down to 10.25. But what I want to look for now, my next trade, just in reading this, I see weakness at the bid, little strength at the offer. I'm looking for this to pull back up towards 17, for the offer to go weak, for strength to come back into the bid for potential short, possibly back down into Friday's low, which is marked down here. So by combining the print and reading the print as a process with the, and this is the other thing I love about the volume profile, it is so visual. Just looking at the structure of the volume profile, all of this activity is what I would call very weak structure in the market. So I would be looking for a pullback up back to this area, 17.25. And if there's continued strength at the offer, I wouldn't make a trade. But if the strength comes back in at the bid, weakness at the offer, that's where I would start looking for executing on a trade, sell market, and look for a potential of 10 or lower. Now the other scenario is that if there's strength back into the offer up here, I don't have a trade. The print would tell me not to make a trade, and I would look for buyers, because this is still a key level for me. I would look for buyers to push back through with some significant volume and momentum, and then look for a long on the other side of this and look to take this higher, and actually back up towards 32.50, which never really finished in my estimation from Friday. So we've got a little bit of a test further down. Again, the 17 area is where I'd look for 17 to 17.25, look for a trade short. And this is the other thing I love about this, using this system and trading like this, is I can go short at 17 if I would get filled there, put a limit order in at 17, and I literally can put my stop at 3 ticks. And what I'd be looking for is, if sellers are successful at holding the buyers, I would be looking for price to move back down, and possibly all the way back down to 19.10. So when price came back down to this 15.50, 15.75, I would be looking for more strength back into the offer. If I got into this trade at 17, they hold, it starts coming down, price starts moving back, and I see strength coming in at the offer at 17, 17.25, I can simply get out of that trade with a very small stop, maybe 17.50, 17.75. And it doesn't matter to me on this trade, because one thing I see is weakness at the bottom, of these rotations. So again, what I would need to see in a trade short is strength back down at the offer, or the bid rather. It's 1575 and 1550. And if I had that, that would give me additional confirmation, and I would start looking for price to come through 1475, possibly back down towards 1225 and possibly further. And all I'm doing is using the volume profile to help me identify those areas. And then I use the print at a specific point to help me identify the trade location and whether or not the trade is working. So again, the short was back here, 17 quarter. And what I would be looking for is I'm looking for strength to come back in the bid where it was weak before. I'm looking for this to change. And we've got weakness, a little bit of relative weakness, so I'd be watching this auction. If this is all it's got into it and price starts coming back up and I see strength at the bid or at the offer at 17, I don't need to think about managing that trade. I would rather take a break-even trade or a one-tick loss than to see a significant amount of buyers push this thing up, even if I only had a 3-tick stop, and take me out. Because my trade is working so far. I got more strength coming back into the bid. This is great. Now all I have to do is determine where my first scale opportunity is. And we're going to go through that in trade management. But again, the point in all of this is as we look at the bid and offer, and we read it as a process and point in time, trade management, trade entry, opportunity, we have the ability to trade with the buyers and sellers. We have the ability to find those locations where there's a high probability for buyers to step in, sellers to step in. Once the print continues to confirm, then using volume profile based on what recent area of interest are with buyers and sellers, we have a pretty good understanding. Nothing is absolute, nothing is certain. We have a pretty good understanding of where price is most likely to go. And if the print continues to confirm that it's moving in that direction, we can hold that trade to just in front of that first potential target test area. Okay, let's see, a couple more questions. What is the red dash line? Oh yeah, DB answered that. That's the low of the day. I have one indicator that is that marks the 24-hour open, then the high and the low of the day. Do I use previous day value area as possible entry exit setups? That's a good question, Jim. I look at previous day's value area, and this is, we're going to get into this a little bit later in the day. So one of the things that I've come to learn as a student of the auction is order flow incredibly important. Incredibly important. It is the lifeblood of the auction. It is the representation, what is actually happening in the auction. But as I've come to understand the auction, and I understand intrinsically the guiding principles, the fundamentals of the auction, I know that the market moves from balance to imbalance. I know that it will continue to probe higher, probe lower, move up, move down, and get in balance. I know those things instinctively. So what I am always doing is identifying areas that tell me where buyer, seller sentiment or strength or weakness is, and then I'm looking for the print activity by buyers and sellers to show me that there is actually weakness or strength there, to confirm it, if you will. If a value area, so I'll look at a previous day's value area, and I'll look at the activity in that value area relative to the current auction, and I'll make a determination whether there's relevance. So for example, if, let me just pull this over and see if I can get to, yeah, I can do this. I can do anything. So let me show you this. Don't ask me about this setting because we're going to get into it. This is a series of volume profiles that only represent the RTH session for the ES. Okay, they only represent RTH sessions for the ES. In this scenario, I don't care at all about the overnight or pre-market volume or activity. I just care about the RTH session. So what I can see from Friday is I have a value area. This is my value area. You can all see this, right, on this left side of the screen? Okay, because I want to make sure I answer this question. So I can see this value area, and what you can see from today is a move back up as a high to, is that 2550, I believe? Yeah, 2550. 2550. The value area high from Friday is 27. So when I look at VPOC for the day, I can see for the most part, price is rotating in value from Friday. Current value of the day, let me open this up a little bit more. This is kind of scrunched. That's a little better. Current value of today is within value from Friday. So what that is telling me is that even though price did move back down here, 1475, it's now back above 17. Even though price tested lower, what this is telling me so far today is that the market still is accepting price up in this level. I'm actually going to create a new volume profile here. So the market is accepting price, and you can see value within value from Friday's range. So what that says to me is, okay, I want to look at the low of the value area from Friday and understand what it is, 1750. And oh, look at that, I've got a low volume area at 1725. So this becomes, again, an important level. And if price, remember this was an area I was looking to go short if price came down below it. But I had to be careful, right? If there were strength at the offer again, then this could be just a test, and price may just move above this level. And if it moves above this level, comes back down, and there's weakness at the 1725, which is the low of value, there's another great trade opportunity for me here from a risk-reward standpoint, because if buyers, in fact, do step in, let's say this pulls back to 1750, 17.25, and buyers and sellers, or buyers step back in, I can see sellers failing, activity at the bid failing, then I'm looking at the value area, the fact that today's value is inside of Friday's value, which tells me that this market is accepting this range from Friday. There is potential in a trade long, even though this came down, there's potential in a trade long all the way back up through value, up through, got to be careful, there's a low volume area here, 2650, which is why we had this move down from here, but all the way back up through value. And if we start moving back up through value, and we can see VPOC, which was here on Friday, it's higher today, even start to move higher, then that's telling us that there's more acceptance and we're likely to see value start to creep up on the day. So this value area from Friday provides me with a trade opportunity, a risk-reward trade opportunity of, you know, I would have a stop at about a point off of 17.25 if price were to pull back, but the trade opportunity is for almost 10, you know, 9, 10 points. That's a pretty good risk reward. And what the structure of the market is telling me is right now this is accepting, this is where VPOC is, this is where the bulk of the volume is. It's no problem for me that the market tested lower. The market tests all the time. I mean, it probes, it rotates all the time. I expect these tests. It's what happens when the market tests that becomes important. So what are they trying to do? They're trying to bring price lower. Next question is, how effective are they in bringing price lower? Well, they were effective for a bit, right? How effective were they? Well, not super effective. We had at least some responsive buying, and we had a really significant volume spike down at the bottom of the day here, which tells me we have responsive selling, responsive buying. And now that we're above 1725, I have full expectation of seeing price trying to get back to 2050, or well, actually even potentially a little higher. This was the VPOC from Friday, potentially back up to 23. So now I would go back to the print, and I would start to look at what's happening between 1950 and what happened at 17.25, and that would start defining my next opportunity for this day. So if I'm reading this as a process, weakness, weakness. Now notice, I'm not even yet adding a lot of the cluster momentum components to it. And what I want you to do, teach you to do, is do the long math, the long division before using a calculator. These things just make it easier and quicker to read. But I want you to learn how to read this and how to determine context. So look at these bars. And I'm using a 6-4 chart here. Weakness, weakness, this is all at the bid. Each one of these bars at the bottom of the bar shows weakness at the bid. Weakness at the bid. We've got a cluster here showing strength at the offer, a little bit of momentum, and we're getting continued weakness. So again, when I look at this, now that it's come above this 17 level, and you can see what happened. It came above, came down. Remember I said I'd be looking for weakness at the bid. There was weakness at the bid and the long, and now continued weakness at the bid. I guess I don't see any reason for this not to go back up and test this 23 level, which is VPOC. We're back up to the closing swing high from Friday, getting continued strength at the bid. So I hope you can see, what I did here is price came through, key level, and what I said is I want to see what happens when it retraces. I don't want to just take a breakout trade. I see the momentum, that's great. I don't want to just take a breakout trade. What I also see in this is I see buyers just going, forget it, right? I look at all this activity over here on the offer side, and I look at their effort, and buyers just said, we're stepping away. We're stepping away from this auction. And so I'm looking for them to re-engage, either holding or re-engaging. Re-engaging, re-engaging, re-engaging. I'm looking for buyers to re-engage, and they did that with continued weakness at the bid. So when I look at that, it tells me, well, there could be a trade here. Had weakness at 17, strength coming back into the offer at the bid at 1675. Even if you took the short, like I said, you would have had a limit order looking at 17, so don't know if you would have gotten filled. Once it started moving away from you, you would have needed to take that limit order off because you only want to, we'll go through this, but you only want to take it the first time. But once you started getting strength back into the offer, there's no way you want to take a short. The print told you weakness at the bid, weakness at the bid, weakness at the bid, strength coming back in at the offer. There's no way you want to take a short. Your risk is significantly higher. Does it mean the trade won't work? No. But your risk starts to become significantly higher. And even if you were one of the 104 contracts that got taken, that got filled there, when this started showing strength to this weakness, whereas before this was strength at the bid, you'd close your trade. And you'd say, my next trade is waiting for this to pop up with, what did I say, momentum. I want to see big volume coming up through it. I want to see a pullback down to that 17 quarter area, or this area. I want to see weakness at the bid, strength at the offer for a long, and I would start looking up towards 23. I want to see now if price can get back, buyers can take this back, not just back to 23. I want to see them take it through 23. I want to see them take it through 23. And if they do, that tells me that this is fair price again, and we actually may see prices move higher. Now, I'm not saying that it will do that. That's just what this structure tells me, and what the print tells me is if we get through 23 and we continue to see strength at the bid, then we're back into accepted prices. We're accepting fair value from Friday still. We had a test down below here. That test failed. So this level still becomes a key level between 1775 and 17. This becomes a key level. And if I were to make a sell, enter a sell again, if I were to say, okay, I'm going to sell, I would not want to sell until I saw sellers take out these buyers and bring this back down below this level. That's my only scenario for a sell. Possibly another top up here, but that's not really something I'm interested in. Why? Because of my fundamental that says price will continue to move in a specific direction until the other side steps in to shut that movement off. What did buyers do? See all the pressure to the downside? Bid, 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 bid. What did they do? They held. They stepped in. See, you see them walk away here? See all the weakness on this side? They walked away. Basically, buyers just got out of the way. They relented. There was no significant activity at the offer in this move down. They said, okay, you got it. We're out of the way. So what I'm looking for inherently is, do they continue to step out of the way, or do they step back, and where do they step back, and what happens where they step back? They step back in. They held, and they step back in. Weakness, weakness. I don't have a long yet. All I know is that this level now is at risk for buyers to push through, and my long is on the other side of this, looking for 23. So is what I'm talking about making sense? Trust me, I'm giving you, we're staying on course here relative to the order flow, reading the bid and the offer. I told you I'll always give you live examples of what I'm looking at. I'm not ever going to go back into history and say, well, okay, here's a nice setup. I'm going to show you live what I'm reading in the print. And again, I read the print as a process, and right here as a moment in time opportunity. Pull that over right there. There's my opportunity, right? What did I say? I want to see momentum coming back up through here, or I want to see weakness. And this is the other thing. I love this. I love this. I love this. I could never do this before, but now I can do it. Is even if I saw this right here, 104 by 2083, and I said, oh, I have a short opportunity. I'm looking for price to pull back to 17. Like I said, I'm looking for weakness at the offer and strength at the bid, and I said short. Let's say I didn't have a limit order at 17. I did a market order. I got it at 1675. Right, 1675, and price tries to pull back a little bit to here, comes back down. Let's say I get a scale, and now starts marching back up. And where right here, 1675, where there was strength, now becomes weakness. Instantly it tells me my other contracts that I might have on are at risk. They're at risk because sellers are not as active as they were. There's strength back into the offer. Here at 17, I need to do something with this trade. All right, what happens? I close the trade, and I'm now my other scenario, like I said, is I'm waiting for price to come through with momentum. I'm looking for volume. And then when if I see weakness on a retrace, a pullback, weakness at the bid and strength at the offer, I'm in. Because my trade is potentially up to 23 and possibly higher. And that's a great risk reward. And am I afraid of getting in short again? No. Because let's say I get in here let's say I get a bad fill, I get in at 18. If I start seeing any strength back to the bid down at 1750, see these momentum dots here, 17 quarter. I see, I'm going to give it some room this time, but I'm out at 1675. And if it stops out and pops back up, I see strength coming back into the offer. That's fine. People are going to get stopped. I can't prevent stop runs. I can't. All I can do is manage my risk. I have to know myself, know what my objectives are, know what my risk tolerance is, and manage my risk. So I take my loss, And if I see the weakness where it took me out, and I see strength coming back into the offer, I just go back to this and say, above this level, the probability with acceptance up here is that we're headed back up to test 23. And so that's where I would look to trade. All right, let's
Mark,
yeah.
I'm going to step in real quick if you don't mind. I think you've done an excellent job thus far. I know everybody's been sitting for about 2.5 hours. And
has it been 2.5 already? It feels like 15 minutes.
Well, yeah. And I just want to make sure that we stay on course. I think
you're right.
You're delivering excellent material, but a couple of things that I was saying early on, it's very hard for people to focus longer than a certain amount of time, and so I want to make sure that we take some periodic breaks. And I think you've been really engaged in your chart. I was trying to send you messages earlier, so I figured I'd just jump in.
Sounds good.
If it's okay with you, and we're at a decent segue here, let's take about a 10-minute break, if that's okay with everybody. I think it's important that you get up, walk away from the screen, that kind of stuff, and we'll regroup if that works with you.
Yep. So let's just mark it at would be 11:30. Does that sound good? Eastern, 10:30 Central.
You got it.
Great, and then I'll go through the rest of the material for today, and we'll do questions and answers. Thanks, DB. I appreciate it.
Yeah, you bet. It's just important to take some breaks.
No, you're right. Yep. I told you, I can talk about this stuff for days on end, so I get energized by this. So, all right, let's come back around, 10:30, 10:33, that type of thing.
Continue, and I just wanted to note we had said 11 Central, and I have a feeling you'll want to probably run long on that. I just I don't want to put people out who have a fixed schedule that they were counting on the day to wrap up. So
I'll make sure I get all the information in by that time.
Well, yeah, and I also just want to note, I mean, obviously we're going to record everything, but it's not quite the same as getting to participate live, and so I don't think it's fair to run long. It's not a time concern for me. I could care less if everybody's in to stay all day. That's great, but I know that there's probably people who have other commitments. So we'll do the best we can to stay focused on the material, but still give everybody as much of it as they need.
Thanks for the hook. All right, let's move on then, and we'll come back to the chart later. Now that we've taken a look at a live chart, again, as a process for context, right? In looking at order flow, we are watching some specific things. Specifically, we're looking for unusually high volume. Where it comes into the market, and you can use the VCA, where it comes into the market, and what kind of volume is it. And again, the most important part, a lot of people just look at the volume and look at the cluster and say, okay, we have a cluster, it's at the bid, so it's selling, and therefore we're looking for price to go back down. And we just had a real good example of why that's not always true. As price right here, as price moved lower, we had a selling cluster. I mean, if you just look at this piece of information, one might think this is going to head lower. This is another selling cluster. We're in good shape. We can go lower, and that just didn't occur. So seeing the cluster is one thing, and it's great to have it. It's a kind of a warning thing for me. This warning, take a look. I always go back to the print. We want to see what the effect of that volume coming in is on price. So two important things. Where is the volume coming in? and what effect is that volume? What kind of volume is it, and what effect is it having on price? So we also, as we look at using order flow to understand context, we want to see where buyers and sellers relent, shown by weakness, or in my case, blue in the print. And that's, I showed you an example of that in this last move down. We can do it again. In this move down, right, a lot of strength at the bid. But the other thing, we had buyers, or basically trading at the offer, activity at the offer, which would denote market orders, buyers, aggressive buyers. They just backed out. They just stepped away from the auction. So this move down, even though strength, it was strength over weakness. And what happens to price when this stops becoming weakness? So when strength starts coming back into the market on that side, what happens to sellers? And what happens to their effectiveness in moving price when they step back in? So we could see sellers stepping back in here, but we clearly could see active buyers again, and then finally back up over this level, which gave opportunity for that long. So again, if we're looking at order flow as understanding it, using it as a process for market context, we want to see not only where volume is coming in, what kind of volume it is, and this is important, what the effect of price is. Remember, we're always asking the two questions, and you can write these down. What is the market trying to do? The market being defined by buyers and sellers, and how effective are they in doing what they're trying to do? So the market was, in that case, was clearly trying to go lower. How effective were they? Well, they were effective as long as buyers were on the sidelines, but as soon as buyers started coming in, they weren't effective at moving price anymore. What does that tell you? It tells me that the price is likely to go the other way. So, and the other thing again here is where buyers and sellers relent, where they back off, shown by weakness in blue in the print. Again, that's my custom color, is the blue. Also, as a process for understanding overall market context, we want to see the print at the high and low edge of a rotation. So like this morning, and I showed you the print at the top and the print at the bottom showed weakness on each of the edges. What that meant is, and with a fairly good distribution in the middle, there was no trade to be made in the middle. So what that automatically signals to me is my only trades are at the edges. And then I have to determine what kind of trade do I want to make, what's the most probable trade, and what is the condition of that trade. So at the edges of a rotation, we're looking at context. So if price comes back down to the low, and I also see strength at the bid, and weakness at the bid and strength coming back into the offer, that's telling me that I may have a long trade back up towards the middle, or even towards the top of the day, at least towards the middle, which is where I'd want to scale. Same thing at the top. If price moves up to the top of a rotation and I see weakness coming in at the offer and a lot of strength coming back in at the offer, that tells me I may want to take a short back down towards the volume profile of the VPOC and point of control, volume point of control, or even further towards the bottom. So we use that as context, right? If strength comes in back at the offer at the top of the day, well, we're likely going to go higher, or at least they're trying to go higher. If strength comes back into the bid at the bottom of the day, whereas last time it was weak, that tells you something as well. We're getting context by using the order flow and using the print to tell us what to do, how to read it, how effective the buyers or sellers are. The other thing that I do that's important for me, and we're going to be speaking mostly about the ES this week. So in the pre-market to me is this transition from around 7:20 to 7:45 all the way through to the open at 9:30 Eastern, a.m. Eastern. Like I said, I get up early and I start looking at the market around 7 Eastern, 7 a.m. Eastern, and I start looking for volume, and I start looking for opportunities to determine, as the U.S. market steps in and I can see that by more volume, What are they trying to do and how effective are they in doing it? So by the time the open actually happens, I have a pretty good feel for what the U.S. market is trying to do, how effective they are. For example, if we're opening up out of range from the previous day, does the U.S. market agree with it? I can see that in the pre-market, in this transition from pre-market into the RTH session by reading the print and price movement during this time. So again, we talk about order flow, and there are two ways of using order flow. As a process, order flow is a process for understanding context, and these are the things that we're watching for. And we also use order flow as a point in time for entry and trade management. And as a process for trade entry or management, we're specifically watching for a couple of things. The activity at the bid and the print at two levels. So for example, let me bring this back over. As I am looking for a potential short here, as price comes back up, one of the things I noticed is that the volume profile, we're going to get into this tomorrow, the volume profile showed this is a finished auction to the bottom. Doesn't mean it was, but for right now, the volume profile showed it was finished. So as it comes back up, I'm looking diagonally at the offer and at the bid, but at the offer and the bid, I'm looking at the top two combinations, maybe even the top three. And what I'm watching for is, this is great that I have strength at the bid and weakness at the offer, which would tell me I have a trade. But just below it, I have strength at the offer and weakness at the bid. I would rather see either these be neutral or continued weakness here at the offer, or at least neutral at the offer, and more strength or greater than neutral, some strength back in at the bid. I would rather see that, but when I don't just look at this combination, I look at the one below it, and I want to see what's happening between buyers and sellers. If you look below, there were two sets of combinations where there was strength at the offer and weakness at the bid. And I'm looking for a short. I could take that short, but what that inherently tells me is there is risk to this trade because buyers are pushing. They may not be pushing right here, but they are just below that. There are buyers present, which tells me the trade may work, so I can go ahead because I have this set up. I could take the trade, but if I get any kind of strength back at the offer here, I need to start managing that trade. So hopefully what you can start to see is by understanding this and practicing this, you can effectively manage your risk, which is, again, can't stress it enough. It's what you are as a trader first. You're a risk manager. And there is nothing that I have ever found in trading that helps me manage risk and stay objective more than the OFA order flow print. Nothing, period. And I've been doing this for a long time. And this helps me stay objective more than anything else. And when you learn to do this, you'll be able to make very good decisions. And even if I took this trade and I got out and all of a sudden strength started coming back into the offer and it started working, that's okay. My job is to manage risk. I would rather manage risk appropriately because what it's telling me is I made an objective decision based on what the market was telling me, based on what buyers and sellers were telling me. And as long as I can say that I'm continuing to do that, I know that I have control over myself, my capital, and my risk. It's when I just let things go and hope that it'll turn around and I don't act on what the print is telling me that I wind up in trouble. So that's what we want to get to by the end of the week, is getting you to be able to read this and, more importantly, to be able to act on it so that you too can be a risk manager, an effective risk manager in the print. So I'm looking at the activity at the bid and the offer, but I'm looking at it at a couple of different levels. Okay? At least 2 levels, sometimes 3. If I'm long, then weakness at the bid and strength at the offer. And if I'm short, then weakness at the offer and strength at the bid. And what at the top 2 prices, if I see, like I showed you, weakness at the offer and strength at the bid, and I'm short, I don't want to see the combination just below that with strength at the offer and weakness at the bid, and then another one with strength at the offer and weakness at the bid. I don't want to see that. That inherently tells me that there are buyers present, and just below the level I'm looking to get in, they are pushing. I need to start to see strength coming back into the bid at the lower levels. I'm okay with giving up a couple of ticks. I would rather do that than let those buyers take me out, especially when the volume profile showed I had what I would refer to as a finish to the downside. Do I just watch or trade the pre-open? I will trade the pre-market. In fact, one person asked me about being able to trade the pre-market prior to their work, and I would tell you that the volume profile is relative to a specific, whatever time you are looking to trade. The volume profile is relative, and we're going to get into talk a little bit about sessions. And one of the things, especially with the ES, you just need to understand is that 80 to 85% of the volume, the overall volume on the ES is in the RTH, the US RTH session. So if you try to compare a volume profile with the RTH session to, say, the European session, you may get two very different looking profiles that tell you two very different things. And the one you really want to pay attention to is the one that you're trading. So if you want to trade in the overnight, and trade the European session, then you can use a volume profile effectively in the European session because the volume profile is relative to the amount of volume in the instrument at any given time. So CL and TF, those are very thin instruments historically, and the volume profile is very effective with those tools simply because it's a visual relevant relative tool that regardless of how thin or thick the volume is, will give you a perspective of what the context and structure of the market is, regardless of the market. So I do trade the pre-open. The only time that I would tell you that there is some risk in terms of misinterpreting a volume profile is at that time I showed you from about 7:20 a.m. all the way through to the cash open. Excuse me. When the U.S. market participants start to enter the U.S. market, and trust me, they do it prior to the open. That's just where the initial big push of volume is. They start to influence and start to change the profile from the overnight session or the European session. You just have to be able to follow it and understand what that, if there is a change, if they're agreeing with what the overnight European session is saying, great, you've got a great volume profile to make trades with. If for some reason what they're doing is contrary to what you see in the profile of the overnight European session, that's the only time you need to start moving towards the print as opposed to the volume profile. Crossing over sessions can give you a little bit different read just simply because of the difference in volume. So they're also very important when using thin, low-volume instruments, again, like oil and the rest. I just talked about that because they're relevant and relative to the amount of volume for a specific instrument. And we're talking about strong bid-ask level and weak bid-ask level. So these settings become very important when using the print to enter or manage trades. So I'm going to go into this. I'm going to go into the settings on my OFA Ninja chart and my OFA Ninja indicator. And we have strong bid-ask level, weak bid-ask level. And you know that you can choose from 1 to 5, with 1 being the easiest, 5 being the hardest relatively to getting a strong or a weak print or color based on what your color codes are. So it will, excuse me, it will adjust the algorithm so that it's either relatively easier or more difficult to show you strong or weak at the bid and ask. So in an instrument like the ES, where there is a significant amount of volume, and you have strong responsive buying or selling, for example, I'll bring it over in a second. Strong responsive buying and selling. So let's say you get a print at the top, 500, 0 by 559 and 2,297 by 1996. In the ES, it may not make a hill of beans a difference whether this is 1 or 5, because the volume is so thick, and you can make strong 1 or 5, and the color is going to stay the same. When you start getting into, and I'm not saying it will, there are certainly some places on the ES where if you change these numbers, you're going to get different color showing you strength and weakness at the different levels. But when in general, when you start getting into a thinner instrument where you have significantly less volume, and you move to like a CL or a TF Russell, where the volume is significantly lower, and the difference between the bid and the ask is 10 or 15 contracts, then if you're using the print and you're using the colors to help you make a decision in strength or weakness, you really want to crank this up to 5s, 4s and 5s, to make sure that on the thinner volume, it is really identifying the strength or weakness at the bid, that it is harder to identify strength and weakness. So if you're using the free tool, you don't have the ability really to adjust this. If you have the full version, then where you want to adjust this, and I recommend that you practice with this. Take a couple of whatever chart you use, 6-4, 8-4, 12-3, whatever it may be, and we're going to go through different probe and rotation discussions, but that you play with this and change the settings so that you can see what the difference is. But in general, this isn't kind of a rule of thumb, it's not an absolute. The thicker the volume, the book, the less relevant this would be. That's why I have a 3 and a 2. This could be 3-3, and it's really not going to change my trading too much. But the thinner the instrument, the thinner the overall book. If you're using these colors and strength and weakness as a basis for trade, then you really want to crank those things up so that it is showing you where there is stark and significant weakness and strength, relative weakness and strength. Okay, so the bid and ask levels, very important, especially when you're dealing with thinner instruments. You need to increase, in general, you need to increase these settings when the auction is thinner. So one of the things I want to talk to is creating a volume profile chart. It's very easy. Intraday, we're going to go through this later, but be mindful of session start times. Highlight key areas from previous sessions. Use structure chart. Mark the key levels on your order flow chart. I'm going to show you all this, and use specific colors that are meaningful to you. So looking at an intraday volume profile chart. Let me just show you on the ES here. Get rid of this. Let me just show you on the ES here. Now you can see in just printing the order flow. I have from 10:50, this is Central Time, and if I want to go back to the actual volume profile, it's over here. But with the volume profile, you have the ability to right justify this or left justify this. And if you right justify it, it will always be on the edge of the right edge of your screen. You just need to make sure that that you're over, that you can still see, you can see the print and the volume profile effectively. In order to create a volume profile, let's say I'm interested in seeing what the profile is of this last swing low to swing high. Weakness at the top, weakness at the bottom. I'm interested in just seeing what the profile is. It's easy enough to just select it. You click on the volume profile tab, and you left click your mouse button, and you let it go, and then drag all the way over. And if you want it to continue, just all the way over to the end, and then there's your volume profile for just this swing. And it's really that easy for everything. So if I take a structure chart, let me just show you this. That's intraday. Let me just do this here. All right. So here's another session. This is a structure chart. And this, kind of getting ahead of the slides, but this allows me to create a volume profile over time. So what I've done in this is I have a probe and rotation of 30-15 on the ES, and this allows me to get on a whole chart and go back 90 days. So I want to see from this swing low to this swing high and everything in between, what is the sentiment of the buyers and sellers in this time frame. And so what I can do, like what I did here, I'll just get rid of this. Is you select volume profile, you go to your beginning bar, left click, and just you'll see it cover everything, and simply drag that over. This is the old contract, so I create another one from this first bar through this last swing low, so that I can get this volume. This is the old contract. I'm going back that far, and I'm not using a continuous contract in this. You can't. So if you want to start getting additional history, this is what you look to do. So I could, if I want to just, for example, take the last swing low and swing high, I really just want to get the buyer and seller sentiment in this range. Because if you think about it, this really is no big deal, right? Price moved higher, it moves lower. We see that in a day. You know, price pulls back to this level and people start talking about major corrections in the market. I don't know what gives you that impression, because this is what the market does. It moves higher and it moves lower. So if I want to just capture all of the data relative to this area, I can see the low volume area here continuing to be at 17, and I can just start marking these low volume areas, and this of course lines up with what I see here, and these start to become the levels that I'm interested in for trading. This is what I start to use for my trade plan. So it's you select volume profile, just click on it. You go to where you want to start, left click, let it go. That sets the anchor, and then you drag, and once you're at the end of where you want it to be, you just simply left click again, and your profile will create itself. In terms of Dirk, higher numbers for thinner markets, yes. That is my rule of thumb. That is my rule of thumb on the strength and weakness, is higher numbers for thinner markets, yes. And I encourage you to go in and compare whatever chart you're using, whatever probe and rotation chart you're using. Go in and compare. Look at the difference, especially at the edges where you would have a trade. So again, relatively easy to create a volume profile chart. Like I just showed you, longer time frames. Use Globex or specific session data. So for example, on this last chart I showed you, it's the ES, but it is the 7x24 session, 24/7 session. I have another chart that I use. Let me bring that up. And this chart is only the CME US Index Futures RTH session. So what this is doing for me, it is only giving me data between 9:30 and I guess that would be 4 o'clock Eastern. And the reason I do this is because I know that 80 to 85% of all the volume on the ES occurs within the US RTH session. So if I'm trading the US RTH session, and I know that there are times when the European and US sessions, different things happen overnight, and they have different perspectives on the economy and the world and the markets. I care about what these buyers and sellers' sentiments are if I'm trading this session. So I have another chart that I can go back however many days I want to and just get the RTH sessions. I can do a whole profile. Again, all I have to do is click on this, set my anchor, and that'll give me a whole profile of all these days. Or I can do individual days. And the reason I would want to do individual days is I'd want to see what is value doing. Value is moving lower. What's BPOC doing? It's moving lower. I'd want to see how this market is auctioning. And, you know, for example, today, BPOC is a little bit higher. We may still see higher prices yet today. We certainly are getting acceptance down there. So that's how you build a volume profile chart. It's very easy to do. The other thing that I absolutely love, I just want to do a shout out, awesome way to go, DB, is this toggle switch for the structure chart to move from order flow to structure chart. That is awesome. I love it. So using longer time frames, you can either use Globex 24/7 or specific session data. With the ES, I recommend you have at least one chart that's RTH only. CL oil is a very global instrument. It doesn't really matter. I recommend leaving the 24/7. Though you do need to understand that the majority of the CL volume is still in the US RTH session, which starts at 9 o'clock Eastern. And when I trade oil, and we'll go over this Friday, I create a new volume profile starting at the session open at 9 o'clock on oil. Make sure you use a structure chart, otherwise you won't see the profile. You can set probe and rotation settings higher so you can get more data in on your screen. The goal here is to get if you're looking for example, 3 months like I have on the one chart, if you're looking for a 3-month volume profile chart, because that's what the rotations have been, then you need to go back that far. And the only way to get that on one screen is to use, like I have, a 30/15 probe and rotation setting. Otherwise, you're going to be scrunching data up, and you're going to be moving back and forth. Still very effective, but you'll move your charts around a little bit. So use your structure chart, set your probe and rotation settings higher, and use at least the last swing low and swing high for one full rotation. And what do I mean by that is, and we're going to talk about this when we do our planning, is if I want to get an effective volume profile that I can use for trade planning and trading, then I need to, at least in my volume profile, include the last swing low and the last swing high. So I need my data to start here and end here, but have another swing low. So this is good. We're in this rotation right now in the ES. If we break below this level right here, we're going to be in a previous rotation, and we'll use other data for that. So at least get a swing high, swing low. Now, the way you would do that, let's say this market was developing and we were only up to this date right here. All right, let's say the market breaks higher. We're only up to this date. If I move this over, we're only up to this date right here. then what you're going to want to do is at least include this swing low. You can see where this quote-unquote support level is. You want to get all of this data in up to the top of the range as your volume profile. Just the one thing you have to understand is all of these low volume areas, high volume areas, the structure is built on a market that is trending. What you don't have, what you wouldn't have, in fact, if I were, it'll overlap, but if I were to draw another profile just for this data, this volume profile is going to look significantly different. If price is trending, and you can count on this for the day too, if price is trending in a day and you've had no pushback in the other direction, when price stops moving and the other side steps in, if it does, to shut that movement off and starts moving down, all of your levels will be based on a market that is just auctioning higher, is trending higher. And so the levels that sellers believe are unfair may not be the same as the buyers. So anytime you can get a full rotation, low, high, low, and a volume profile, the more accurate this is going to be, because you've got your push from buyers and your push from sellers. And now this includes unfair highs for both of them. I hope that makes sense. Would I recommend, well, we'll get it, Ed Moore, we'll talk about that on Friday. Question is, what would you recommend for the 10-year ZN Treasuries timeframes? I can bring that up and take a look at that. And on Friday, we'll have an opportunity to ask about different instruments too. And the key is when you understand these fundamentals, and you understand some guiding principles and rules of thumb, like thinner volume, you want to make those numbers higher on strong and weakness. You can start effectively, very effectively, start experimenting or simulating or tracking, probably a better word, tracking different instruments and capturing the nuances of the different instruments relative to probe and rotation, strength and weakness, volume profile, etc. All right, so we've got how to build a volume profile. I want to make sure we stay in time here. Again, you want to see levels for a probe higher and lower. That's true with the day as it is with a longer time frame. Now, the other thing I want you to remember, everything, and we'll talk about this tomorrow, everything that you learn about volume profile, all of the elements are exactly the same, whether you're talking about an intraday volume profile or you're talking about a 3-month volume profile. All of the elements are exactly the same. That's why it's important to learn the fundamentals. So real quickly about the market profile, it was the first tool created to help traders see the auction, the buyers and sellers interaction in electronic markets. It uses time as a proxy for volume, just simply because we didn't have the technology to track all the volume, and now we do. So it uses time. It basically says, well, if time spent, if price was here for this much time, then, and it was here longer than any other price, then this must be the most volume. And we know that's just simply not true. But it uses time as a proxy for volume. I consider that to be a weakness. It does not consider or track order flow. I consider that a significant weakness. It's broken up into half-hour segments. It's just something that somebody made up, and not made up like fabricated, but it has been the standard way they've been using it forever. And it is still a very popular trading method. I mean, there are courses out there, and Jim Dalton, who's an excellent trader, I mean, he's a pure market profile enthusiast, and that is what he teaches very strongly. And there are people who follow that and trade using that. I believe that there are elements of the market profile that we're going to go through here quickly that are valuable to us, just simply because some people still use it. So again, few elements of the market profile that are effective elements and effective tools. Specifically, what I'm going to share with you, I want to be really clear that what I'm going to share with you, these tools with the market profile, are specifically for the S&P 500 E-mini, when you start getting into things like gold and oil and the 6E, Forex, there are a lot less traders who use market profile for things outside of the U.S. index futures, and therefore they are less effective. Elements act as reference points with the volume auction tools that we'll be using in the course, and here they are. So what I want you to do is, you don't have to write this down now, but these are the elements of the market profile that we are going to use going forward. First one is called initial balance. It's the high-low range of the first hour of trading in the RTH session. You can also accomplish this with a 30-minute bar chart. Let me just take a look and see if I can give you an example here. If I look at the first 30 minutes of first hour of trading today, I have a low of 1920 and a high of 2550. There are many times when that low or that high, and you're going to see this as we get into examples, there are many times when that low or that high, at that lower high, creates a low volume area. And they are, when that happens, they become unbelievably wonderful setups for trades as a continuation, and I'm going to show that to you. So the first hour of trading in the RTH session is called the initial balance. Different open types. It identifies the auction at the open and provides context for the day. So part of the market profile, they'll talk about open auction, right? That's and we'll talk about this as we go forward. An open auction is, and it's in the terminology, an auction that opens up and there's trading on both sides of the open. An open drive, where there's very limited trading to one side of the open and strong trading, which we could see in the print and in the momentum and volume clusters to the other side. Open test drives. There are several different times that provide context for the day. And then day types, which identify context for the overall structure and pattern of the market. So these are the elements that we will be kind of taking forward to understand in our trading, because they apply to either identify an area, like with the initial balance, or they help to provide context in market structure. The next one is open and closing swings. Now remember, the auction causes price to move higher and lower as buyer and sellers interact. What I am interested in seeing from the open at the beginning of the day is, what is the first push by buyers? Once I see the first push by buyers and I see sellers start to interact, I want to see how successful and where sellers are willing to take price to before buyers step in. I want to see that opening swing. The opening swing allows us to see the initial push by buyers and sellers. Very, very important for trading to understand where the initial push is. The closing swing allows me to see the final push by buyers and sellers. At the end of the day, as traders are closing their positions and managing their positions, what is the closing swing high? What is the closing swing low? That takes me into and provides context, especially the closing swing provides context in the overnight session. And I'm going to give you a quick example of that. Here's our overnight session from last night. And the Euro session opened up. Price started coming down. This purple line is my closing swing high from Friday. 21.25 was the last push by buyers on Friday. And as price came down, look what happened as it touched 21.25 in the overnight session. I mean, there was further weakness touch here. In fact, you wouldn't have even gotten filled here at 21.25. But a great trade. The closing swing high and low, just in the overnight, they're great levels. But the other thing it does for me the next morning is if I look at my opening swing high or low, it just gives me a sense to say, okay, is this overall market accepting a little higher or a little lower from where this ended last night? And it just gives me a sense for what buyers and sellers might be trying to do in this current day. These swings are not based on time. So some people may say, well, the opening swing isn't at the first minute of trading. No, the opening swing is not the first minute of trading. And some people ask the question. The opening swing is the first push by buyers and sellers. And even in a probe and rotation chart, if you have a large probe and rotation, you are not going to be able to catch the opening swing effectively, especially on the ES. You just won't be able to see it because you won't have the rotation that enough to show that to you. You'll get a significant probe. You might catch it in a smaller one, but not necessarily because the probe and rotation is not time-based either. This is initial push, and it's marked from the open of the session. So again, I'm going to show you how to do these things. And because the OFA bars are based on overall probe and rotation, I'm going to show you how to do this. I use a simple 2500 chick chart. It's very easy for the ES to mark these levels. It's not that the probe and rotation won't do it. It's just a different level of measure because they're not time-based. And what you'll find is those initial push by buyers and sellers are wonderful reference points very often in the trading day. Again, the closing swing is the last push higher and lower by sellers up to the 4:15 p.m. Eastern time. Again, I use a simple 2500 tick chart. There's only two other charts that I use outside of my OFA charts, and they're not because OFA can't do the job. They just give me a different perspective on the market. When I trade, I want to be really clear about this. When I trade with the OFA charts. I do not use any of these other charts to trade with. I just use them as opportunities to identify levels. That's it. Other important levels, previous day activities represent context. They just represent context for the most recent interests and convictions for buyers and sellers. So things like, we'll get into it. The areas are good reference areas, and when I say reference, I mean reference. As we work through a trade plan, I'm going to show you how to incorporate these previous day's activities into a trade plan. We're looking for significant or the majority of confluence, meaning agreement in different levels across different time frames. And when they line up, when these reference areas line up with other reference points, specifically within a volume profile, it adds confluence as potential trade opportunities, so I have more confidence. And again, when price gets to the point where I'm looking to make the trade, my eyes become glued to the order flow chart. Glued to the order flow chart, and that gives me my confirmation to get into the trade or not. And I can't think about it. Once it says, yep, I'm going long, I got weakness at the bid, strength at the offer, I'm in. And I know how to manage it from there. So that's my trade entry. But the levels tell me where I might want to start considering a trade. And depending upon my overall objective, financial objective for the day and my risk tolerance, I'll know where to likely manage that trade to or where to take my stop. So things like previous day's high, previous day's low, previous day's close, settlement. I know you guys use that a lot. A naked VPOC. A naked VPOC is a previous day's VPOC that has not yet been touched in a subsequent cash session, RTH session. So, for example, when I look at this chart, I see on the 30th of July that we had VPOC up here at 64.75. And then we gapped lower, and the market moved lower. And we have not yet touched this VPOC. That's a naked VPOC. The relevance and importance of this VPOC is if we start breaking through this level, specifically 56.50, and we have a scenario in the print where I have momentum and I can see strength at the offer coming through this level, I know I'm taking a long on a pullback at around 58, and I know where my target is. My target is right there. I say 50, yeah, at 65. At 65.25. 56 to 65.25. That's my target. And I'm going to look to take a scale right in front of that area, because the probability of price going back and at least satisfying that VPOC is very high. And what I'm going to start doing, I'm going to take some off in front of that VPOC, and I'm going to look to see what happens to buyers and sellers at that VPOC. There are a lot of times in a day where price will come back to that VPOC, tag it, or one tick shy, and turn around and just fall. So these naked VPOCs become very important levels, because once you're back up in that area, price gets back above that 55, 75, 56 level. That is my target. And so what that helps me do is I look at the print, I look at my target, and as long as the print continues to confirm that price is moving up, then I can keep my target where I need to. And that's, potentially there a 5-point trade. So naked VPOCs. The other one is naked closes or settlements. So a previous settlement that has not been touched in subsequent cash sessions. And all these are levels. And we're going to identify these levels, and we're not necessarily going to trade off them, but we're going to identify them as opportunities. Remember, what we're always looking for is strength and weakness of the buyers and sellers and what they're trying to do in any given market. The most important market is the day we're actually making the trade. So it's we've been going on for a long time. I've given you a lot of information today. Like DB said, this will all be recorded. What kind of additional questions, and I think there are some here, what kind of additional questions do you have? We can go through them.
I just wanted to bring up that I did post a link that is, if you scroll up a little bit, there's a course glossary. That's available on the course page where you guys logged in this morning. So, if you get kind of wrapped up in some of the terminology and you want to scroll through it and find something, it's all there for you. So try not to get overwhelmed. For a lot of you, this is, you're familiar with some of the basic concepts or very much in depth. I saw some people posting stuff about market profile. But if this is new to you, don't get overwhelmed with the terminology. There is a glossary for you, and of course, you can always, make sure and follow up with Mark as well.
Yeah, and I think you all have my email. And DB made one comment about this whole course. He said learning to customize. If there is a subtitle to what this course is about, it's about learning to customize. It's about learning to read and get context of any market. And again, I don't mean that as a one-size-fits-all tool, but understanding how to architect and how markets are structured and how that structure creates areas of opportunity and probabilities for targets and things of that nature. So learning to customize so that you can become kind of your own trading guru. So you can become your own teacher in a sense. And the goal is that you don't need anybody else but the market to teach you what you need to be taught. You just need to know how to read it, and you need the tools to be able to read it, and that's what OFA provides. And real quickly, we're looking for 23. The most logical place for price to go is VPOC. Remember, there it is, and now we want to see what happens at the bid and the offer. This strength here, this looks like we may get what's called a neutral day, which means we're going to see probability of price even moving higher. At some point, I'm still looking for 32 as a potential level, but we'll see. Let's see. Question: is that on a half-hour basis, or it's the market profile is half-hour basis? I really didn't want to spend a lot of time on market profile. I wanted to give it its props relative to it was the first attempt at trying to identify the activity between buyers and sellers in an electronic auction. You know, once the open cry pit sessions were eliminated, you know, and you couldn't read hand signals anymore or look across the pit and see when big players were buying and selling. Excuse me. At that time, and everything went electronic, you had to be able to identify. Sorry, you had to be able to identify what buyers and sellers were trying to do, and the market profile was the first attempt at doing that. Given the data that was available at the time it was created, it did a very good job. The tools, the data that are available to us now are so much more advanced and easy to use than were available at the time market profile was created. So I wanted to take those things that are still relevant to trading, at least in my opinion that I've seen, relevant to trading, and being able to use those relevant pieces in this course and not spend 3 hours or 4 hours going through market profile. Because I think that personally, I think that it's a great tool for structure, not necessarily the best for specifically identifying trade opportunities and entries. Other people may have different opinions, but I wanted to make sure we just looked at the critical elements. I don't know when the, DB says he'll send out an email to know when the recordings have been published and the link to that. On my 6-4 structure chart, do I have to draw the VP every day? Good question, Jim. This is what I like to do is on this 6-4 chart where I'm just using the RT8 sessions, yes, I draw the volume profile every day. I started at 8:30 because that's when this chart starts to collect the tick data and the print data, and I start this profile from the beginning of the day. And the reason I do that is because the RT8 session can just be different than the Globex, and maybe not by much, but it's enough to make some levels much more specific for me. So this one I start every day. Yep. And it's so easy to do. I mean, it's so easy to do. And with the toggle right up at the top, I mean, the only thing you could do is have the tool system, I don't know, maybe write it for you. But that's what I do for that session. So you would not even look at market profile, just at volume profile. That is correct. When it comes to trading, there's element of the volume or market profile, which is the IB, the initial balance, the first hour of trading, and you can do that in a standard 30-minute chart. There's an element of the of that I use, and the open types and day types are just really good, quick summaries of what the market's trying to do at the open, and to identify in a nutshell overall structure of the market. So I use that terminology at times, but nothing replaces volume. And I will tell you this, as you start to look outside of the ES, and most people who teach market profile teach it relative to the ES because there's so much volume. If you try to start using market profile outside of ES for trading, it becomes infinitely more difficult because the rest of the world doesn't necessarily use market profile, and in more global markets like oil, gold, Forex, it becomes even less of a relevant tool. Again, outside of things like open type. At the open of any market, I don't care if you're looking at the Euro, US, Forex, I still want to understand when that market opens in Europe, that session opens, I want to know what the first push is by buyers and what the first push is by sellers. That's going to set my context for that session. And then I'm going to start looking at the auction around those areas, and that's going to help me start to identify trades. It's going to help me build structure for the whole session. So those things are important. If I see at the open on oil, for example, the market shoot higher and the volume profile, and it comes right back down, the market profile shows really thin volume in that profile, and we're getting acceptance lower, then that is likely an open test drive. And then I'm just looking for confirmation in the print that it's a failed open test drive, and I'm going to start to look for shorts to the downside. So there are elements that just make sense in the market profile because it's a tool to identify buyer-seller interaction and context relative to structure. It's the same thing with the volume profile. It provides a structure. That structure provides context for what the market is trying to do, fair price, unfair prices, etc. So I talk about market profile just enough to use what I believe to be relevant tools relative to the auction. How much weight do I give the actual open as a reference throughout the day? It's a good question, Jim. I mark the open every day. So on this chart, for example, I have the open marked right here. I have my open swings are marked by orange. Here's my opening swing high, opening swing low. And, you know, for example, when price came back up to opening swing low, you can see what happened. We started getting rotation back down. I can see VPOC now for the day is, sure I got that. VPOC on the day is down at 21 now. Was up at 23, back down to 21. But again, here's my opening swing high. Here's my opening swing low. When price came back up to the opening swing low, you can see what happened. We had weakness, strength at the bid, and opportunity for another trade. Now, some of you have asked me about scalping and opening swing, high and low for the day can offer great opportunities when the print supports it for doing that, for scalping. And then again, in the overnight, these closing swing high and lows, I just cannot even tell you how many times they act as unbelievable support and resistance levels on the ES in the overnight sessions. So I hope I answered that question. So I give the open, I mark it and I give it relative weight at the beginning of the day. And so I look at the auction as price comes back to the open, right? So at the beginning of the day, if, let me go back to it. Beginning of the day, I'm looking at the open, and what I'm doing at the open is, and this is where you use order flow as a process for context, is above the open. Here it is. Above the open, let's say price moves above the open like this. What I'm looking at is, all right, price is moving above the open. I want to know what kind of strength these buyers have above the open. How much commitment and conviction are they having above this open? And I can see the price moved, but I can also see when this first time when sellers actually stepped back in, they were effective at being able to push price down and through the open. And if price starts rotating through the open, once it starts doing this, I really don't give it much weight at all. I mean, it may be relevant if price moves very far away and the first time back up to the open like this, there may be an initial bounce. But once in the morning, the open becomes irrelevant, meaning price is just passing through it. It has no relevance as a place where buyers and sellers have any kind of conviction or interest. I let it go. I keep it there throughout the day, but once it proves not to be a key level to the market, I just let it go. Does that make sense? Do I look for confluence of the volume cluster area levels and volume profile? If so, how do you give weight to them relative to each other? Great question, Wayne. And fortunately, that's what the rest of the week is for, is to take tomorrow we go through volume profile and the elements of the volume profile, so you understand that. And then then there's going to be a test tomorrow. And that test really is for you just to kind of cement what you've learned in the last 2 days and give you a framework for some questions on Wednesday. But that's what this is all about, is then taking the volume profile and volume cluster and momentum. When am I giving more weight to a volume cluster that shows activity at the bid? When am I giving more weight to a volume cluster that shows activity at the offer relative to the volume profile? So we're going to, great question. If I went through that now, I couldn't go through that without going through all the elements of the volume profile. I couldn't do it effectively. So it's a great question. Please keep that, Wayne. If for some reason I don't go through that, ask it again. Yep. Yeah, no problem. Actually, what it tells me, Wayne, is that you're kind of getting it and you see a correlation, you see a relationship. And so it tells me that that you see an opportunity there, and which is great. That's awesome. And I can tell you there is an opportunity there, and we're going to go through it. Does the RTH market profile stop advancing automatically at the end of the RTH session, or do you draw it at the end of the day? Again, the market profile session I don't really use. It's the volume profile. On this chart that I showed you, it will stop advancing at the end of the day. It just stopped. Like on Friday, there it just stopped. And then at the beginning of the day, I just click, open, bring it to the end, and I'm good. It'll build automatically to the end of the day, and then it stops. Hope that answered your question. Do I think volume profile is well applicable to FGBL? Dirk, if you could spell that out for me, that would be great. I don't think I know FGBL. Yes, I would say absolutely. I have not traded that. We can certainly take a look at that. My goal is by the end of the week is to be able to show you literally in any market, including stocks, how you can, if you're trading options, how you can use the volume profile to identify areas of trade and be able to trade stocks or options more effectively as well. And the reason I can say this, not just from experience, is that the volume profile is nothing more than a representation of buyers and sellers' activity. And it shows where they have interest in price, and it shows where they don't, unfair and fair prices. And once you understand that, and you can get some confluence across some different time frames, you really have some powerful levels to make trades with. And it's in all markets, because again, the basic principle, and this is why I pound my head with people about this, is that every market is an auction. So why wouldn't you use a tool set that, like OFA, that focuses on helping you read the auction? It's it's like I don't know, going to a circus and bringing a bowling ball expecting to bowl. It doesn't make any sense. If you're going to the circus, bring some popcorn and expect to see clowns. If you're trading in an auction, use tools that are auction related.
Mark, I'm gonna jump. I was gonna jump in with some questions if you're through the list there.
Yeah. Yep. Pretty much.
I see Jim just posted something displayed during the session. How do you turn them on? Well, the value area doesn't have specific lines. It's represented by the price level where the histogram cuts off from one to the other. So okay. Anyway, I kind of wanted to play devil's advocate a little bit here, because we obviously have there's a room full of people here who have paid good money to come and sit into a class, and I want to make sure that we are bringing value every single day. And sitting back looking at some of the questions, I could tell some of the questions were leading into a process that or an application that we're likely to get into further further along in the course. And that always happens. I mean, the minute that you're into a course and you see something that interests you and you want to ask a question, and I heavily encourage that. What's surprising is I didn't see a lot of questions about the actual content of the day in terms of really the foundation that you went through. So just for my own understanding, because I'm kind of treating this as though I'm your student right now, even though this is my tool set, but you know, I very much want to get the most out of this. And I guess would my understanding be correct that the overall objective for today was to kind of lay the foundation of why these pieces fit together, and not necessarily how they fit together in terms of step 1, step 2, step 3 to take a trade, but in the sense that I shouldn't drift off on any of this, because at the end of the day, I have to believe, or as you said, realize that there are these truths about what I'm looking at, and you know, my reluctance to kind of let go of what I'm doing and actually focus on this is, you know, there's a that could almost be I guess troublesome in some regard to looking at a course like this. And what I mean by that is, you know, I'm always creating and developing and evolving as a trader. And so whenever I teach a class and I say, well, this is exactly what I'm doing, and then you know, 6 months later I'm looking at something else and doing something else, and somebody says, well, gosh, I mean, why are you doing that if this is what you taught the last time? And what I love about what I got out of today is that you're looking at all of these pieces and you're saying they're all here, and there's not any need to look anywhere else or to do anything else or to add anything else, but you really have to get these pieces and have the belief system that and I don't mean leap of faith. I mean, look at it and say A plus B equals C. I get it. You know, the only thing that's going to move price is the buyers and the sellers. The only thing that's going to make my trade work or not work is the trade that comes in afterwards. I want to make sure that that's what the goal of today was so that I kind of get that sense that everything fits together. You know, we're not teaching you a magic trade today, DB, but instead I just want you to know that as this week progresses, if you don't have your head around what we talked about today, it's going to give me room to drift. Is that a fair assessment?
That's a very fair assessment. Yeah, if you don't, these things, and you have to go over them kind of again and again and hear them, like I told you, I'll be repeating these things over and over again. But if you don't have these as kind of fundamentals, guiding principles for your trading, my experience and my experience with other traders is you'll be following what you believe to be the next great thing. And in my experience, the market is an auction. OFA toolset was built to display the auction. In order to trade effectively, there really is nothing more than I can see that anybody would need to trade effectively in many different markets or instruments. So that's correct, and that's why we start with this. And I want to make sure everybody is at the same place, so that when we start getting into trades, again, the print and the volume profile, what you see on your chart is all you have, and the print is truth. You will always have uncertainty and ambiguity in the market. If you lean on that, you will always second guess yourself, and you will be a nervous trader, and your psychology will fall apart. If you lean on what you know is truth, what the buyers and sellers are actually telling you, you have a significantly better chance of controlling your risk and managing your patience and your trades objectively by what you see in the auction. And so yes, if you get these principles, these truths, then what you will see, and what the goal is of this course, is to show you that you don't need anything else to trade with, to trade effectively with.
And I think that's exactly what I was looking for. Part of the reason I asked that and kind of went around in a big circle, I know there wasn't probably a full coherent thought there when I was asking, but I could even feel myself while you were going through the chart. I could feel myself trying to grasp something. You were saying, okay, well, there's a weak print here and a strong print here, and this is where it was. And I kind of felt like for a moment there, maybe I missed something. Should I be 100% clear on what it is that you're talking about,
No.
looking at it, and that's what I was kind of getting at, is that I think after that I took a step back and said, I think he's giving us an overview of what we're going to learn, not
this isn't what you're learning, right?
Yeah. Okay.
Right.
I just wanted to be very clear because
yep.
I want to make sure that everybody has. If there was a moment there where I felt like I was too stupid to understand what was going on, I didn't want anybody else feeling that way as well. So
that's a great clarification, and I certainly don't want anybody feeling stupid. What I would tell you is, when I started learning this, and it was literally about 1:30 in the morning when I ran across some article, I couldn't even tell you where it was from, that talked to the market auction theory and what market auction was. And it hit me like a light bulb once I finally started understanding what this means to my trading. And it took me years to get to the point of understanding it. The whole course was developed, and the sequence was developed so that people's learning curve could be increased greatly. So I don't expect that people will get this after today, but my expectation is why we're going to do the test tomorrow, and then we've got some homework to do for Wednesday and Thursday night, is that the test is probably going to generate some more questions, but by the time we get to Wednesday and Thursday, specifically in the homework areas, even if somebody doesn't have, I don't want to say the right answer, or didn't answer something in the homework, when we go through it in the morning, there's going to be this much faster, oh yeah, oh yeah, okay, got it, okay. And so it's sequenced so that the learning curve is dramatically increased. And what I would expect is by Thursday, and we get through the homework on Thursday, at the very least, people are going, oh yeah, oh, okay, I get that, I get that. And then it's a matter of repetition. So today was getting you to say, look guys, your psychology is probably killing you. And your psychology is killing you because of the unknown. And anytime a human being gets into an uncertain, unknown, ambiguous scenario, it's a proven scientific fact that your ability to interpret data objectively goes down significantly. It's why the term choke comes in sports. Goes down significantly. And there's no greater place than in trading where you experience that. What I need you to do is to understand that this is an auction. These are the auction tools. These tools show you strength and weakness of buyer and seller, who are the only ones that are going to take your trade to profitability. As you learn to read them in context and in print, your trading will become significantly better because you will understand what it is they're trying to do, when you're likely going to be right, and when you need to manage your risk.
Excellent. Well, thanks so much for addressing that. I see there's another question on the board, a couple of them, so I'll
and real quickly, there was a question about the value area lines. There is a setting. Let me just find it here. There is a setting in the volume profile. It's right here. Show arrow labels. Just say true, and you should be able to see these: value area high, value area low. This is VWAP, and that's VPOC. And sometimes these get a little bit, covered up. It doesn't really matter to me. That's why I make the colors the way they do. I make the colors so it's. Go ahead.
You'll see in the settings that you can put it behind the chart, you can put it in front of the chart, to the right, to the left, and really it's because there's no perfect place to put all those things. So, I think once you guys play with it, you'll notice that you can kind of switch the orientation around enough to where if the labels, if you can't see them because price has been going back and forth over the same area, then you can flip it to the other side. You'll get the hang of it. So.
Yeah, and when we go through volume profile tomorrow, What I'm going to teach you is what's relevant is that you use the volume profile to identify these levels. And once you've identified these levels, you can put them over here on your chart here to just to give you the reference point, like on this chart, on your order flow chart. Trust me, this won't take long for you to kind of see through this, and there's nothing even to see through. This provides a structure. It's just what it is. What it is, and that's why I make these colors very specific, because I can quickly say, okay, top of value is 24, bottom of value is 20. We're rotating nicely within value. It just helps me interpret the market very quickly. So good question. I hope that helped. Are my closing swings from previous days upper and lower value areas? No. Closing swings are literally the last push by buyers and the last push by sellers of the day. And we're gonna go through, when we start identifying and doing the homework, I'm gonna show you how to mark those. Good, thanks, Ralph. Oh, good, good. He says some minor ahas are forming. Good. And you know, today and tomorrow, I don't mean this to be kind of drinking from the fire hose, but it's a lot of information. When the pieces start coming together, even tomorrow, as we start talking about volume profiles, as I start talking about the volume profile and you understand the elements of the volume profile, you're going to quickly start to see where the opportunities are and how to relate this back to the order flow and the print. And then the volume cluster analysis and the momentum analysis as well. The connection isn't going to take real long. I think I'm just trying to save it for the, you know, like a magic show, right? I'm save it to the end there. Yeah, you're welcome, Michael. I can't stress to you, order flow to me, it's kind of like the way I describe it, or describe it to myself, is you know, back when I was in junior high, I feel like I'm talking to my kids now, but back when I was in school, we didn't have calculators, and we got a piece of paper and a pencil, and we had to do the math ourselves, and we had to know the equations. And now you have calculators, you just punch in numbers and you get all the answers. Well, a lot of kids these days don't know how to do the math. And you know, I go to places and somebody's trying to make simple change and they can't even make the math and you know, in simple change. And what I can tell you is it's the same thing with trading. If you come to rely on indicators for your trading, I know this because I experienced it. I blew up accounts because of this. If you come to rely on indicators just for your trading without getting the context, you will blow up your account. You will lose. You won't win consistently. You'll get into a trade and you'll hope. You'll have what I call please God trades all the time. Please God, please God, please God, please God, all the time. When you start to do the math and you can use the order flow to understand context relative to some of the other things that we have, the initial pushes and the volume profile, I'm telling you, in the market can do anything, but in every market, you are going to have more control over what it is you're seeing and the patience that you will start to gain in terms of waiting for areas, because you inherently understand that by waiting for that area, you have minimized your risk and maximized your risk-reward ratio. When you begin to understand those things, it can control and get patience, and then take the trade when it presents itself. You will find yourself at a different level of trading. And any nuance that comes from there, for example, DB talked about doing other things, will just simply be to help you see the auction better. So I don't care what newfangled thing comes out tomorrow, what somebody might come up with. You're going to be able to weigh that in relation to understanding the context of the market and the auction, and be able to quickly say, that's a bunch of bunk. There's no way that they can do that. There's no way that that can be effective. And you're going to be able to see something, and like I saw with OFA. This is a perfect example. When I saw OFA, I said, holy cow. And DB, you know, I said this from the very first phone call we ever had. I said, this is it. If there's any way of reading the market and displaying the electronic auction, this is it. Nobody does it better. This is the tool set. So when you find something that helps you read the print or read the structure and the context better of what buyers and sellers are trying to do, then add it to your repertoire, or find a nuance within a specific instrument. For example, oil. Oil is different than ES, not just in volume. And oil and CL, when we start looking at it on Friday, is in terms of levels. Volume profile is a good tool, but oil, especially within the day, can be very mechanical in its levels. And when you look at pullbacks, retracements, and extensions, and I'm not just talking about Fibonacci, but when you look at retracements and extensions, oil becomes this incredibly mechanical tool. And when you have these levels that line up with your volume profile, you start to have confluence for amazing trades in that instrument. Gold is similar to it, but of course gold is a very emotional product, and I don't like gold just simply because this is just a personal opinion, I'll get off it, but at any given time during the day, oil can rocket higher or crash lower without any warning because of what some Yahoo did in some part of Africa. Who knows? So it's just very, very much a volatile commodity. But anyway, you will start to be able to go to different instruments. For example, somebody talked about the 10-year note, I think it was, and start to identify the nuances of the auction for that note. You'll start to be able to play with the probe and rotation and the strength and weakness settings, where you can dial in a very effective portrayal of the auction for that instrument, because you're going to understand the fundamentals. You're going to know what you're looking for. And once you know what you're looking for, it's just a matter of working with it to get it. And so, like, to me, if I don't get my money out of the ES, I'm moving over to CL. I'm moving over to oil. And I can get to meet my profit target for the day in oil.
Mark, I just want you guys are more than welcome to stay and chat and answer questions. I've got to run to a meeting.
Yeah.
We're slightly overdue where we were, but I just wanted to thank you very much for the presentation today. I'm anxious to see tomorrow. I know even I need to go back and review some of this, and so as soon as I have the recording ready, everybody here will get an email. It'll go into the course homepage. Just wanted to say thank you again, and I'm going to cut off, but by no means does that mean everybody else needs to. But I will see you guys in the morning.
Okay, thanks, DB. And then you'll end the recording now?
George is actually running the recording, so whenever you guys are done with your discussion, he can flip it off. I don't want to cut it too early in case there's something.
Yeah, it's about noon. Yeah, I think that I'm from a significant standpoint. It's just more of clarification, and I could spend the next 3 hours clarifying things. But I believe that as we go through tomorrow and we start connecting the dots with the volume profile and the other elements that we've talked about today, I honestly don't think it's going to take people. In fact, you'll probably, I don't want to say laugh at how easy this is, but you'll probably make the connections pretty quick with the rest of the tools.
All right. Well, thanks again. Right. And
yep. All right, guys. I think I'll wrap it up as well. Thank you for the questions. Remember, at the end of the day tomorrow, I just get to figure out a way with UDB how to get the test to people. It's not a grade thing. It's just to help you set your level of understanding and ask some questions. But there'll be a test and then homework on Wednesday and Thursday. All right. Thanks for the feedback, gang. We'll talk in the morning.